What is good, everyone? So in today's video, I'm going to be going over my entire strategy, my entire trading strategy that has made me over 6 figures and is what got me profitable, right? And in this video, I'm going to be sharing everything about it for free, completely for free, A to Z. And I'm not even joking when I say this, but I could be charging, $1,000 for this information. But obviously, I'm not the typical demo guru that relies on course sales and flexes Rolexes in Dubai or rented cars or whatever. No, obviously, I'm here to provide you information, valuable information that could potentially turn you profitable. So do yourself a favor here, trust me, watch this video until the end, take some notes. It's gonna be a bang, all right? Take some notes and watch the entire video because this could turn you profitable. I'm not even joking. So we start off with the foundations on why the strategy works, how it works, and when it works. And after that, we'll get into the more advanced stuff on, some technicals, top-down analysis, volume corresponding to different pairs, and all that good stuff. It's gonna be a banger, trust me. But I want to say something before we get into it, right? I do have a 16-page free PDF file going over this entire strategy on paper, on a PDF file, right? So if you haven't downloaded that, make sure to download that for free. It's in my Discord. It's going to make everything much easier to understand because it is basically the strategy that I'm talking about, right? But without further ado, download that. And yeah, I'm yapping too much now. Let's get into the video. I hope you enjoy. Take some notes, watch until the end, and yeah, see you inside. What is good, everyone? So this right here is what the strategy is all about, the breakout plus liquid web strategy. So to put it into fewer words, it is basically taking advantage of a stop out or a wick out or a liquid grab, same thing, right? And then taking advantage of that momentum and volume after the liquid grab. That is literally it, okay? So we don't trade like 99% of traders because 99% of traders are, let's put it into bearish perspective, a, low, lower high, lower low, lower high, and lower low. Now, realistically, is the market going to reject here? Yes, it might reject, but it's not going to push all the way down, most likely, right? Because everyone is in the position. When everyone and retail traders make money, the market loses money. When the market makes money, everyone else loses money, okay? And obviously, there's a reason why 90% or 99% actually lose money in trading. Like 99% of retail traders lose money, aka, the market wins. The market wins all the time unless you create an edge, right? That's what this strategy is all about. It is basically an edge, right? Obviously, it doesn't work without proper psychology, but that's like any other strategy. But basically, instead of taking sell positions right here, like most retail traders are doing, because let's say that 95% of retail traders are getting into positions right here. Now, is the market just going to push down and everyone makes money? No, it's not going to do that. It is going to push up and then stop out everyone with their stop loss up here, and then it's going to push down, right? That's how the market tricks everyone into, hitting their stop loss and then hitting their original take profit. So the market makes money, basically. The market makes money and everyone loses money, and that is what we want to take advantage of. Now, it is like, I'll show you an example here real quick before we get into all the details of it. But look at here. Let's say that everyone was in sell positions right here. Stop loss up here, take profit down here. Looks pretty solid for a sell, right? But is the market going to shoot down? No, it's not. It is most likely going to shoot up, stop out everyone, and then it's going to shoot down, okay? So let's see here. This was a trade I took as well. Look, it stops out everyone, and then that momentum after the liquid grab is going to be absolutely crazy. It's like a rubber band. Look at this, okay? Look at this rubber band. In order for price to go up, we need to go down first. And in this example, in order for price to go down, we need to go up first, right? In order for the rubber band to shoot down, we need to do something like this, grab liquidity, stop out everyone, all the retail traders, and then boom, there's going to be a lot of volume, okay? That's how you want to see the strategy. It is basically, in this example, on the charts right now, we are pushing up at market open, and then boom, we get that big move to continue down. If it was, was vice versa, the market needs to go down first in order to go up. So it needs to grab liquidity, grab orders right here, and then push up, boom, right? That's what the strategy is all about. We take advantage of that momentum and the volume after the liquid grab and after everyone has gotten stopped out. That's basically the strategy right there. Now, this may not make, very much sense now, but trust me, it will later on. But just keep going here. Let's keep going with these videos, and let's get into some more of the foundations of this. And after that, the next chapter about the strategy is some timing, some volumes, and some more advanced stuff. But let's keep it going here with the foundation, and I'll see you guys in the next video. Alright, what's good, everyone? So which pairs does it work best on? So a rule of thumb here is that the more volatile a pair is, the more liquidity reps there's going to be, and the more liquidity reps there's going to be, the more positions we'll take, because we take advantage of that move post liquidity rep. If there's no liquidity rep, we don't take a move. It's that simple, right? Now, this strategy works on every single pair, on all time frames, all sessions, and basically everything, right? All pairs, all instruments, everything, right? But it works better on some than others, okay? Because if we go to Euro USD, for example, this is not volatile at all. Like, very not volatile. Look at this. Let's look at market open from yesterday. Look at this. A 4-hour candle is 56 pips here. If we go to US 30, a 4-hour candle is, let's see here, 423 pips. Like, you get the idea. The more volatile a pair is, the more liquidity rep there's going to be. The more liquidity rep there's going to be, the more positions we'll take. So the strategy works on all pairs, but it works better on the more volatile pairs, such as US 30, NAS 100, right? So if you're trading futures, that's YM and NQ, the US 30 and NASDAQ, and S&P 500 ES if you're trading futures. Now that's the most volatile pairs and instruments right there. It also works wonders on gold if you're trading that, and some other forex pairs like USD, JPY. There's a lot of volume on that, and some other ones, right? But a rule of thumb is that it works on all pairs, but it works better on the more volatile pairs. Okay, just keep that in mind. Now that's basically which pairs it works on. Let's keep it pushing here. Let's go into some more advanced stuff. Not advanced yet, but some more in depth of the strategy, on the foundations of it. So looking forward to that. I'll see you guys in the next video. All right, what's good, everyone? So the only 3 phases in trading. Okay, the market can only be in one of these 3 phases. It can't be in 2 or 3 phases at one time. It can only be in one. Okay, there is the continuation, consolidation, liquidity. After the liquidity, it starts repeating itself, and I'll go in depth with this, right? Now, this may get a bit advanced, but this will all make sense, as I said, later on. Okay, so the 3 phases, or the continuation, the first big push, right? Then that's kind of how you want to see it. The first continuation, or the continuation, is the big push. The consolidation is where price is moving sideways. It's indecisive. It doesn't know which direction it wants to go. The liquidity, however, is whenever it stops out everyone, every retail trader or all the early, buyers or sellers. And then the continuation after the liquidity gap, because as I said with that rubber band, look at this example on the left right here. In order for price to go up, we need to go down first. In order for price to move, this move right here, we need to go down first. Look at this, right? So it's in an uptrend. Let's actually make it like I don't know, pink or something. Go up, down, but in order to go up, we need to go down first. Okay, we need to push down, and then with the momentum and volume with that move, right? Do you see this? We need to go down first, and then boom, right? That is what we want to take advantage of. We want to take advantage of this continuation phase. We don't want to be in part of the consolidation or the liquidity phase. No, we don't want to be a part of that. We just want to take advantage of the information that we know that it's in that phase right now, okay? But we want to take advantage of the continuation phase, because that's where price is going to move the most, and we'll get the most, amount of pips and money, right? So that's basically, the 3 phases. Now I'll go into a bit more in depth about this. So the first phase, as I said, is the continuation phase, and I'll do some trade examples of this as well. Now, let's go to the 30-minute here, and let's use the same example as before, because I took this trade and it was a beautiful trade, right? Let's go to replay bar here, right there. Let's go down to the 15-minute. No, let's go to the 5-minute actually. Now, this right here is the continuation, okay? This is the continuation. It's a bearish trend. Okay, we've identified that. Now, it's obviously not going to be as clean as this right here, which is, just a few candles. It's going to be more like, you have to adapt to the markets, right? This is the consolidation phase. Price is moving sideways right here, or you can, extend it down to here. Like, there's no clear direction. Do you see this? Price is just moving sideways, right? And this is the move, big bearish move. Then price moves sideways. Then what comes after the consolidation in CCL? The liquidity, right? So the liquidity is most likely going to happen at a high in a bearish trend. So it's going to take out buy side liquidity before moving down. As I said, it's going to move up with the rubber band first. It's going to move up and then boom, right? But we'll get into that as well, like the overall trend, how to take advantage of buy side, sell side liquidity. It will all make sense. But so in this example, I'm anticipating that the liquidity grab is going to be up here, right? So if we use this example right here, it's the exact same thing. Look, bearish move, right? Bearish move right here, bearish move right here, sideways, sideways, liquidity grab to the upside. And then if we get that rejection after liquidity grab, we can take advantage of that move post liquidity grab. So now here at market open, we shoot up. Look, that's the liquidity grab right there. That's the L in the CCL. And after the L, after the liquidity, repeats itself, right? So CCL, repeat CCL, repeat CCL, repeat CCL forever, right? So after the liquidity comes the continuation, which is what we want to take advantage of. All that momentum from the rubber band of pushing up first, right? Pushing, okay, can you see this? Yeah, pushing up first and then boom, right? That's what we want to take advantage of. So instead of getting in early, like right here with these stops up here, TP down here, no, we don't do that. We wait for the liquidity grab and identify that we are simply in a consolidation range. And what comes after a consolidation range? Liquidity phase, right? What comes after the liquidity phase? Continuation phase, which is what we want to take advantage of, right? That's basically how we want to see it. So this, let's just say take profit down here. You kind of get the idea at this point, don't you? And then, shoots directly down to take profit. Beautiful trade, right? That is basically the CCL, and we can go on and on about this. I could, be here for days to just show examples of, this happening every single day, right? But that's the three phases: continuation, consolidation, liquidity, and then continuation, consolidation, liquidity, repeat, continuation, consolidation, liquidity. That is what we want to take advantage of. Remember, we don't want to be a part of the consolidation or the liquidity phase. No, we want to be part of the continuation after the liquidity grab. Okay, that's how we want to see it. If we go in more in depth about this, let's see here to the second page here. That's a step by step. We'll get into this right, later on. But step number one is to identify the overall trend, which is already the continuation. The continuation is the overall trend. Look, bearish continuation right here. Price is moving up. Bearish, no, that's bullish. Bearish, my bad, right? Bullish, bearish, right? Step number two, identify, the consolidation phase. See what price is moving sideways, is generating buy side, sell side liquidity. Step number three, wait for liquidity grab. Step number four, take advantage of that move, post liquidity grab. That's basically it. But I'll get into this some more after this. But that's basically three phases. Remember, if you've been trading ICT before, he calls it distribution, accumulation, manipulation, then distribution, but doesn't matter. I call it continuation, consolidation, liquidity, because that's what I find the easiest, okay? Doesn't matter what you call it, it's all the same thing. There's the big move, then there's the sideways move, then there's liquidity, then after the liquidity comes the big move again. That's kind of how you want to see it. And that happens over and over again, okay? Now, let's actually go look at another example here. I've seen some lately on USD. I mean, I could zoom down to the lower time frames and it'll be over, everywhere basically. But I want to find something very clean here. I want to find something that's clean. You can kind of see it here as well. Because not every example is going to be textbook. It's going to be chop here because it's the market. It doesn't do this. This is a theoretical way of trading it, right? This is a pitch perfect way of trading. It's not that. But it's not going to look this easy to read, obviously, because these candles are pretty good, right? It's going to be looking more like this, right? Look at this. So a continuation here, continuation, then the consolidation where price is moving sideways, right? Price moving sideways here. Then we get that liquidity grab, and then we get that continuation post liquidity grab. That's kind of how you want to see it. It's going to be harder in the beginning to spot these. But once you understand it, it's going to make so much sense. Happens here again. I mean, continuation, right? You can see this is the continuation basically, right? Or you can kind of say this as well. Then price is moving sideways right here, generating, buy side, sell side liquidity. There's no clear direction. Then price is going to shoot down with that momentum, stops out everyone that had their stop loss down here. Liquid grab right there, right? And then we get that continuation post liquid grab, right? Happens over and over again. And we obviously want to utilize this and take advantage of this. And we'll, combine it with market structure and the overall higher time frame. But we'll get into that later on. But that's basically three phases. Remember, continuation, consolidation, liquidity. And we want to know which phase we're currently in. If the trade is already in the continuation phase, there's no positions. The move already happened, right? If it's in a consolidation phase, there is no clear direction. You don't want to take advantage of it because if you try and take positions in the consolidation phase, you'll just end up getting stopped out, right? Look, that's what happened with today's trade. No, Friday's trade right here. If you try and let's actually go to US30. If you try and let me see here, 25 minutes. If you try and take sells here inside the consolidation phase, this is the consolidation phase right here, you'll just end up getting stopped out because there's going to be a liquidity grab after the consolidation. Then after the liquidity, there's going to be a continuation again. As I said, this is the rubber band, right? In order for price to move up, we need to go down first, right? Like this, boom. In order for price to go down, we need to go up first, grab orders, grab liquidity, and then boom, with all that momentum, it's going to shoot directly down. That's how you want to see it. Continuation, consolidation, liquidity, the three phases in trading, okay? I hope that makes sense, but it will, if it doesn't already, it's going to make sense. Trust me, everything will make sense once you watch these video modules. But anyways, that is the three phases in trading. Let's keep it pushing. Let's go to the next video. I'll see you guys in there. All right, what's good, everyone? So the different types of liquidity, right? So in trading, there's only two types of liquidity, okay? There is, let's actually write down two types of liquidity. There is liquidity above or below previous highs or lows, okay? Then there is liquidity, wait, let's actually edit this. Then there's liquidity below, no, let's say above or below, wait, I can't type today, equal highs and equal lows, okay? Now, what are, you probably should know what, previous highs and previous lows are, but previous highs is basically, that like there's liquidity above this high, there's liquidity above this high, there's liquidity here, previous highs, there's liquidity here, low, right? That's why we want to take advantage of this, because if we were to draw out a bearish candle, right? Bearish candle like this, there is liquidity down here, not a lot, and not a lot up here. But we still want to take advantage of that because the price is most likely going to do something like this. Stop out everyone that had their stops up here, because liquidity equals stop losses. Stop losses equals money, and money equals liquidity, okay? In order for price to move, it needs to grab orders, aka liquidity, aka money, aka stop losses. It is all the same thing, okay? So when you understand that there's two forms of liquidity, above or below previous highs or lows, and above or below previous equal highs or equal lows, okay? Once you understand that, you basically know that there's stop losses up there. And when there's stop losses up there, there's money up there. Because look at this. If we just use the same example as before, right? Go a few bars here. Everyone, let's say that most retail traders either has their stops up here or up here, above this high, or above this high, or above this high, or above these equal highs. Now, equal highs are just highs that are at the same exact price point. So this is a consolidation area. You should know this by now. This consolidation phase. There is equal highs up here. Look, these highs never broke these highs never broke these highs never broke these highs. And there's equal lows down here. And when there's equal highs and equal lows, there is liquidity up here. It is what we call buy-side liquidity because it's, above previous highs, and there's sell-side liquidity below previous lows. Now, remember, there's two forms of liquidity, two types of liquidity. Liquidity above or below previous highs and lows. This is basically the same thing as equal highs, but equal highs are just equal highs. Above or below previous highs could be one or two highs, if that makes sense. So this is previous highs, this is previous highs, this is previous lows, this is previous lows right here. But these are, if we delete this, these are equal highs up here. Look, all these highs are at the exact same level, basically. There's a lot of orders up here. There's a lot of stop losses up here. There's a lot of money, aka a lot of liquidity, right? So price is most likely going to shoot up to that equal highs to liquidate everyone that has their stop up there, and then it's going to push down, which obviously ended up happening, and we took advantage of that move, and I made no, I'm not going to say, yeah, I made 6K, but that has nothing, that's totally irrelevant with this video, but that's just to know that I took this trade as well, because it was a textbook play, right? It's a breakout to the downside, the overall trend is bearish, consolidation phase, liquidity phase, continuation phase, right? I hope that makes sense. So remember, liquidity above or below previous highs and lows, liquidity above, above or below equal highs and equal lows, okay? So let's actually draw it in, let's make it a bit more easy to understand here. So the first form of liquidity is in a bearish trend. There is liquidity up here above previous highs. There's liquidity up here above previous highs. There's liquidity here. In a consolidation phase, right? There is equal highs and equal lows. Okay, wait, this low was actually not that equal, but there's equal highs up here, equal lows down here. That's the two forms of liquidity, okay? Above or below previous highs and lows, and above or below equal highs and equal lows, okay? Now, that is some very useful information, because we'll get into pre-planning the trade on how to do it with the trend, with pro trend, and how to identify where it's going to happen, all that good stuff, right? But basically, just from my experience, and because I know that there's equal highs up here, I know that price most likely wants to hunt this before we get that move. So I'm not going to enter here. I'm going to wait for the market to push up to that level right there, right there, and then we can take advantage of that move post liquidity wrap. As I said, it's a rubber band theory, right? In order for price to go up, we need to go down first. Boom. In order for price to go down, we need to go up first. Boom. Right? That's kind of how you want to see it. Then you can target these lows down here. Beautiful trade, 80% win rate. Doesn't get any more simple than that, right? That is basically it. And you can use liquidity levels as your pre-plan analysis for your anticipation of the entry. You can use it for your stop loss. You can use it for your take profit, right? In this example, I would either, as I said, stop loss is obviously above the liquidity wrap. We'll get into stop losses and take profits, but take profit is either below this previous low right here, because there's liquidity here. And whenever there's liquidity, the market tends to react to that or reject that, right? Or I could target, on this trade, I targeted these lows here, because there's some kind of equal lows down here. As you can see, if we zoom down, yes, this did get broken in theory, but there's still a lot of orders down here. Look at this, right? That's what I targeted. And that made totally sense, because look at this red line got rejected, and then we shot directly up after that, right? So that's kind of how you want to see liquidity. Two types of liquidity: above or below previous highs and lows, above or below equal highs and equal lows, okay? That's the two forms of liquidity. Let's keep it going here. I'll see you guys in the next video. All right, what's good, everyone? So where is the liquidity located? That's a good question. I kind of went over it in the last video, but we'll go over it more in depth right here. So as I said, there's two forms of liquidity: above or below previous highs and lows, and above or below previous equal highs or previous equal lows, right? It's not really previous equal highs and previous lows. It's just called equal highs and equal lows, right? You get the idea. If you go to the playbook here, let's see here, right? This is the previous low down here, aka there's liquidity. What does price do? Pushes down, liquidates that, hunts those orders, takes that money, whatever you want to call it, then it moves, right? That's the basic same thing here, right? There's liquidity above the previous high, liquidity wrap, boom. That's basically it, right? Now, there's also in the playbook, you can kind of say that this is equal lows down here. This is almost equal lows down here, because there's, liquidity down here, below equal lows, right? What happens? Price shoots down, boom, up, right? Equal highs up here, kind of say that. Liquidity grab, boom, right? You get the idea. As I said, there's two forms of liquidity: above or below previous highs and lows, and above or below equal highs and equal lows. In this example, I already knew that price would most likely, at market open, shoot up to these equal highs and liquidate all of this, because there is a lot of liquidity resting above these equal highs, because these highs never broke these highs, and these highs never broke, these highs, right? And then there's also liquidity down here. You could also go kind of in depth with it, like there's liquidity here, there's liquidity here, but you get too many lines, and price most likely won't grab that. It most likely will grab all this up here, right? Because everyone has their stops up here, because everyone got in sales positions right there, basically, right? Stop loss up here, take profit down here, right? What happens? Price shoots directly up and then shoots directly down. Rubber band effect, right? In order for price to go up, we need to go down first. In order for price to go down, we need to go up first, right? You get the idea. And then we could use, as I said, we could use these liquidity levels for take profits, stop loss, and entries after the liquidity grab. That is basically where the liquidity is. This obviously depends on pair to pair and day to day, because on some days it just liquidates one candle or two candles. But today, for example, it liquidated, 1, 2, 3, 4, 5, 6, 7, 8 highs, basically, right? So from day to day, the liquidity grab depends on the volume for the day, okay? And we could also, if we fast forward a bit here and go to the 1 hour, look at this. This is also a liquidity grab on the 1 hour. Look, liquidated previous lows. There's equal lows. You can kind of say that right there. And then it's shot directly up, right? So it happens over and over again. That's the basic foundation of it. The market moves based off price action, and liquidity. And that is what we want to take advantage of. So price action is the overall trend. That's how price moves, aka the continuation phase, consolidation phase, liquidity phase, continuation, repeat, right? And then liquidity is basically where we want to enter, and that's basically our confirmation. So the price action is the overall idea behind the trade, and the liquidity is the entry confirmation, if that makes sense, because we want to take advantage of that move post liquidity grab, if that makes sense, because there's no entry criteria here. If I take sells right here, no, yes, price may shoot down here, but it's most likely going to shoot up first, rubber band effect, before it's going to shoot down. So this was the confirmation on this trade I took right here. Stop loss up here, or you could go to the lower time frames. We'll get into that. And then take profit was down here at these equal lows on the 1 hour or something, all the way down here. Yeah, like these lows here, right? That is basically where the liquidity grab, or where the liquidity is located. Let's get into the other videos. Remember, this playbook is here for a reason. If you like the strategy, if you use it, take advantage of this, okay? Because this is so valuable, right? This is all the information you'll ever need, basically, about, you know, the breakout plus liquidity grab strategy. The fake out is the same thing, it's just on the lower time frames, okay? But breakout plus liquidity grab, entry types, setup types, everything in between here, okay? So that is basically where the liquidity grab, where the liquidity is located at, not the liquidity grab, but the liquidity above or below previous highs and lows, and above or below equal highs and equal lows. Yep, that's it for this video. Let's get into the next one. I'll keep it pushing here. Let's go. All right, so what is a liquidity grab slash sweep? So a liquidity grab slash liquidity sweep, it's the exact same thing, okay? Just, you know, it's just being marketed from different gurus online to their advantage, and then they sell something. It's stupid, right? But it's the same thing, okay? A liquidity grab and liquidity sweep, it's the exact same thing. Now, what is it though? It is basically whenever price wicks out and stops everyone out, and then it's going to move, right? So it happens over and over again every single day. It happens on lower time frames as well. It happened right here. Look at this. Broke previous high and continue down, right? It's happened right here. Look, broke these lows right here, continued up. Now, this is not textbook, obviously, but it's just to, you know, kind of get it into your head that a liquidity grab is just a, you know, break of previous highs or lows, or equal highs or equal lows, right? Happens over and over again every single day, right? Look here as well. Broke these highs, liquidity grab, continuation, right? Let's go to some more here. Look, broke previous highs right here, liquidity grab, continuation, because there's liquidity above or below previous highs and lows. In this case, previous highs, right? Liquidity grab, continuation, right? So this is the continuation. If we go back here, I'll probably zoom into the lower time frames. You can see it even better here. Look, textbook. These three phases right here is the let's mark this red. Let's actually go to circles here. Continuation. Then we get that sideways move, consolidation. Then we get that liquidity phase, right? Liquidity. Then after the liquidity, CCL, we get that continuation again. Remember, continuation, consolidation, liquidity. Continuation, consolidation, liquidity. Repeats itself over and over again. Look, it's the same exact move as here. Continuation, consolidation, liquidity. Rubber band effect. In order for price to move down, we must move up first. Right here, liquidity, boom, continuation, right? Continuation, consolidation, liquidity, continuation, right? Happens over and over again every single day. I could even you know, go more in depth with this. There's also one right here. Just isn't that clean. But if we go to the 1 hour, I bet it will be. Or I mean 1 minute. This is the 5-minute time frame. Let's go to the 1 minute time frame. This is more. It isn't that clean here. There's way more cleaner examples, but you can kind of get the idea here. You know, continuation, consolidation, and liquidity, and then continuation, right? And remember, candle closures on the lower time frames is just a wick on the higher time frame, right? So if this, let's put this into perspective as well, because if there is, let's see here, let me think. I need to use my brain for this as well. If there's a candle like this, and then the next candle is a straight push down like this, right? Let's say the previous candle was like something like this or something. Yeah, like this, right? This is basically, let's say that this is the 15-minute time frame. I'll write it down as well. Then, yeah, let's do it actually like this. This is the 15-minute time frame, and this is literally the 30-minute time frame, something like this, right? Right here. I'll actually have to do something like this. Draw the wick a bit up because this needs to match each other, right? But this is the 15-minute time frame, aka 2 candle closures, and on the higher time frame, it is just a wick, 30-minute time frame, right? Because in a 30-minute time frame, there's 2 candles obviously here. 15-minute, there's twice as much, so 4 candles, right? Now, this is the continuation right here, then the consolidation, then the liquidity, continuation. Continuation, can't see it here on the higher time frame, but on the lower time frame, there's a consolidation, liquidity, continuation, right? You get the idea because this wick started here, this body closure started here, exact same price. Look at this, right? Basically, I know my drawings is a bit off, but you get the idea, right? Started right here, closed down here because it closed here. Next candle pushed up, broke these highs, broke previous highs up here, broke these highs, liquidity grab, exact same level again, and then that continuation post liquidity grab. This candle actually had to close down here, right? But you get the idea, right? Let's do it like this, right? It's just so it's perfect here, right? That's the exact same move of the 15-minute compared to the 30-minute. So whenever there's 2 candles, candle closures, it's basically just a wick on the higher time frame. And that leads me to this example, because this on the 1-minute time frame is a wick on the 5-minute time frame, as you see right here, right? Broke these highs, right? That's basically how you want to see it. That is literally it. Yes. So as I said, happens over and over again. Let's go over some more examples here. I mean, it's not that simple, but you can see it here. Broke these highs, liquidity grab, continuation, right? Broke these lows, liquidity grab, continuation, right? Broke these highs, liquidity grab, continuation. Broke these highs, liquidity grab, continuation. You get the idea at this point, right? Broke these highs up here, liquidity grab, continuation, right? Broke these highs right here, liquidity grab, continuation, right? Happens over and over again every single day, basically, right? Broke these highs, liquidity grab, continuation. This wasn't that big, rejected this level, then it broke these lows, liquidity grab, continuation, right? That's what we want to take advantage of, and happens on all pairs. Remember, the more volatile a pair is, the more it's going to happen. The more it's going to happen, the more positions we'll take. The more positions we'll take doesn't correspond to the more money we'll make. But if we do it right, then it corresponds to the more money you make, right? If you take the right setups and take A+ setups. But that's basically it, okay? Now, let's keep it pushing. Let's go to the next video, and I'll see you guys there. I hope this is starting to make sense here. I know it's still a bit advanced, I know, or like a bit confusing probably, but trust me, once you watch all the video modules and try and see it on the chart yourself, everything will make sense. And obviously, Rome, or whatever it's called, yeah, like Rome or something, is that, in my language, that's like Rome. It's like called Rome. I'm not sure if it's like Rome. Yeah, Rome wasn't built in one day. Remember that. Or the pyramids wasn't built in one day. You're not going to understand this just in one day unless you got previous experience with it. It's going to take some time. It's going to take some getting used to it. It's going to take some, looking at the charts, seeing where it's happening, how it's happening, when it's happening. It's going to take time. Not everything takes a few hours to comprehend or learn, right? It's completely normal. Just, watch your video modules, try and implement it on the charts, try and look for it yourself, and it will all make sense eventually. It's going to take a few weeks or a month maybe, but trust me, it won't take you just 1 hour and everything clicks for you. No, be realistic here, right? It took me 3 years to learn this strategy. So why do you think it can take you an hour to understand it completely, right? It's completely normal. It'll take you a few days, if not weeks, and maybe a month, right? But that's completely normal. That's completely normal. Don't rush the process here. But anyways, that's this video for now. I'll see you guys in the next one. All right, what's good, everyone? So this is how and where to draw your levels, liquidity levels and zones, basically, right? Where you want to anticipate and pre-plan the liquidity grab is going to happen, right? Now, if we look at this chart right here, right? Let's actually go a few bars back. So just to keep this in mind, right? In a bearish, let's actually draw a bullish trend first, right? Higher high, higher low, higher high, higher low, and higher high, right? These are significant levels price will most likely reject. But is it going to shoot up here? As I said before, probably not. It'll probably start rejecting, and then everyone gets in, right? All the research traders get in buy, stop loss down here, and then they are going to take advantage of, or try and take advantage of that move, after that rejection right there of a significant level. Is price going to do that? Most likely not. It's most likely going to shoot down, liquidate, stop out everyone, and then it's going to move, right? So as I said, you have to understand whenever you're drawing your level, this needs to be above or below previous highs and equal, or no, wait, above or below previous highs and previous lows, or above or below equal highs and equal lows, because there's liquidity there. We're anticipating that there's going to be liquidity. So you need to make it make sense. Where is the liquidity going to be, right? It's going to be above or below previous highs or lows, and above or below equal highs and equal lows. And it's going to follow the overall trend. So in this case, there's liquidity below these equal lows either, or these, lows down here, right? And then we'll get that move post liquidity grab. So, I mean, wait, why did I draw this on TradingView? But anyways, in this example right here, the overall trend is bearish. Okay, the continuation is bearish. Got it. The consolidation is right here. Price is moving sideways right here. Now, if I were in this trade, or if I was looking at this, I would draw out my levels up here, above this high and above this high, for an anticipation. I was probably going to be anticipating a move up here, and then if we start flipping bearish, we can take advantage of that move post liquidity grab. Look, then the phase 3 comes into play, the L, right? The liquidity right here. After the liquidity phase, we get that continuation phase post liquidity grab. So I would draw out my levels right here, right there, right? Now, I would most likely draw a level, like a significant level, probably up here, or yeah, like down here and up here, right? And then I would draw these red lines, which I am anticipating that there is going to be a liquidity grab, because my red lines are liquidity levels, pools, or whatever you want to say. There's also liquidity down here, right? And that's what I'm anticipating price will move up to and then reject after that. And if it does that, in this example, it also does that right there, I'll take advantage of that move post liquidity grab. We'll get into entries, etc. Right? I'll probably either target this is a 1-to-1, 80% win rate, super profitable, or you could target these equal lows down here. You can kind of say that this is equal lows because these are damn near close, lows right here, right? That's kind of how I want to see it. So draw the significant levels where, I like to see it as, my significant levels are basically levels like everyone else, right? Everyone else has their levels like this. It's a breakout, retracement to this level, rejection after retracement. This is what everyone thinks of. This is what most retail traders think of. They get into buys up here, take profit, stop loss, right? Now, with this information, you also know that there's liquidity below this previous low here. So you mark out this low as a red level right there, and then you wait for that to get liquidated. And if it does that, starts rejecting after liquidity grab, we'll get into entries, obviously. You take advantage of that move post liquidity grab, right? So continuation, consolidation, liquidity, continuation. I think you're kind of getting the point at this point, right? But the red lines is the liquidity levels, which I'm anticipating a liquidity grab is going to be at. And then these significant levels, you can also look at these settings if you want to. Just pause this right here. Coordinates and visibility is obviously useless, but these red lines as well, you can copy these settings if you want to. Style here, like thickness and stuff here. And that's basically, so a rule of thumb, now I don't want to yap for too long, but a rule of thumb is red lines or liquidity levels above or below previous highs and lows, and above or below equal highs and equal lows, right? Significant levels, these boxes here are where price most likely wants to reject. Look, rejection, body closure, never closed above this, never closed below this, right? And that's basically it. There's a rejection here as well. So that's kind of how I see it, right? And yeah, that's how to draw the liquidity levels. That's basically everything about the foundation for now, I think. Let's get into some more about market structure, some timing, some volume, and all that good stuff, right? But that's basically the foundation of this strategy, right? That's how to identify the liquidity grab. What is a liquidity grab? Identify and how and where to draw the levels, what the strategy is all about, the 3 phases, CCL, 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 remember that? And that's basically the foundation of it. Yeah, let's keep it going here, and let's go. Let's make it all make sense here. That was the foundation. Let's keep pushing. I'll see you guys in the next video. So I hope you guys like the foundation of everything. Now we'll move on to the more advanced stuff, which is, some volume, some session timings, some timing techniques, all that good stuff. You'll see, so stick around, right? I do want to say something. If you are currently struggling with becoming profitable, struggling, with trading, you're not, it doesn't click for you, if you know what I mean, right? I do have a one-on-one mentorship. You can watch the private video in the description. Everything's tailored to you. It's not a signals, group. It's not a course. It's nothing like that. It's a one-on-one mentorship, right? Everything is tailored to your problems, your situation, right? So if you want access to that, you can, watch the private training in the description. And otherwise, I hope you guys, enjoy the next chapter, and I'll see you inside. All right, what's good, everyone? So understanding volume in different sessions. So there's obviously only 3 sessions, and you should know this by now. There's Asia, then there's London, and then there's New York. And a thumb of rule here is that the Asia session is the least volatile, and then comes London, and then comes New York. So if we were to rate it from a scale of 1, or like who's in first place, who's in second place, and who's in third place in terms of volatility, liquidity / volume, right? New York would be number 1, right? Most volatile session by far. London is number 2. Asia is number 3. And a thumb of rule here is that Asia typically consolidates and moves sideways, right? And then Asia and London combined is typically the session that generates the liquidity, the buy side liquidity equal highs, or sell side liquidity equal lows, right? For New York and NYSE to push through that, to make that, grab that liquidity and then move later on in New York session, right? That's typically the thumb of rule, and that happens, most of the time, right? So if we were to draw it out on a bearish example here, let's actually go to a clean chart here. Bearish example, a push down, then a consolidation, right? And then we get that liquidity, and then we get that continuation again. So continuation, consolidation, liquidity, continuation, right? CCL. Now, this is typically, let's actually write this down again. So let's write Asia, London, and New York. So this is typically the previous New York session. Let's actually make Asia first. So Asia is orange, right? Then London is pink, and then New York is green, okay? So Asia typically is the, Asia and London is typically the consolidation. It's just moving sideways. In London session, you may get a, a small push, but it's most likely at NYC or New York Open that we get that big push, that big liquidity grab, and then that big move after, after NYC and later down in New York session, right? So if we were to push this onto the charts, this would probably be Asia session here, then London session right here, right? And then at London and Asia session, it is generating buy side, sell side liquidity, right? Liquidity equals stop losses equals money. Price wants to hunt this money, but it's most likely going to hunt it in New York session at either 8:30 a.m. Eastern, so New York Open, or NYSE Open at 9:30 a.m. Eastern, or 10 a.m. or 10:30, okay? So those are kind of the 4 main timings you need to master in trading, right? If you're trading New York session. So London Open, if you're trading London, and then Asia, Asia session. I mean, you shouldn't be trading Asia. Like you just shouldn't. Like that's just the honest truth. Asia's just, it's not. Yeah, from my experience, it's not that good. I haven't met anyone that trades Asia session only that's profitable. Okay, but I mean, obviously you could if you really want to, if you really like it and it really works with your strategy. But London typically get a small push, right? Maybe a mini liquidity grab. So like maybe something like below these lows. Do you see this? This kind of broke below these lows right here. Maybe get that in London. But typically, thumb of rule, Asia and London is setting itself up for New York session. Okay, so Asia and London is generating liquidity above or below previous highs and lows, and at equal highs and equal lows. So Asia session, London session, generating buy side and sell side liquidity. And then New York session, we get that big liquidity grab, right? And then we get that continuation post liquidity grab, right? That's typically how it is, okay? That's kind of how it, that's basically how to understand volume in different sessions, right? We can get into some understanding volume compared to like how it corresponds to different instruments and pairs, and we'll get into that after this video. But that's kind of how it is. So a thumb of rule, Asia moving sideways, London may get a small push but still moving sideways, and Asia and London is just setting itself up for a big move at New York session at NYC 9:30 a.m. Eastern, and then after 9:30 a.m. Eastern, so at 10 a.m. and 10:30, 11, we get that huge move, right? Then there's potential for runners and so on, right? So this is the whole New York session. And this is also a New York session, by the way, from the previous day, right? So New York session, then Asia right here, then London setting itself up, right? Buy side and sell side liquidity, New York session, NYC strikes, and we get that big move. And then after that, we will probably get some kind of consolidation in Asia session, then the same thing in London, and you kind of get the idea at this point, right? CCL, and then we get that liquidity and then the continuation, right? So that's kind of how it works by understanding volume in different sessions. Let's get into how volume corresponds to different instruments and different pairs. I'll see you guys in there. All right, what's good, everyone? So how volume correlates to different pairs and different instruments. So if you're trading, let's just say Forex first, and then we go over to futures after that. If you're trading Forex, let's say Euro, USD, it's going to be more London and New York focused, okay? Because there's the Euro and then there's the USD, right? So Euro, London, USD, US, New York, right? So it's going to be more London and New York focused. If you're trading GBP, USD, it's most likely going to be more London or New York, as I said again, because it's JP1, GBP, Euro, right? And USD, US, New York, right? If you're trading JBP, JPY, it's more likely going to be Asia to London, right? So Asia, because it's the yen, you're corresponding, it's like GBP up versus yen, right? So it's going to be more Asia and London. It's most likely not going to be that much New York session in that. If you're trading USD, JPY, it may be, a bit Asia and a bit New York. You kind of get the point here, right? So it's what is up against each other. So the US dollar against the Japanese yen, if you're trading Forex, right? That's how, like, US dollar is obviously a New York session. Japanese yen is obviously Asia session. So it kind of goes hand in hand there, right? Now, if you're trading futures such as ES, NQ, or YM, so US 30, NAS, and ES, right? It's heavily NYC focused. I mean, heavily, right? Heavily NYC focused at 9:30 a.m. Eastern, right? So if we go to the chart here, let's actually go back a bit. No, let's go back before all this madness when Trump spoke. So I'm recording this, which, this was history being made yesterday. I'll just show you guys this because you're going to see this probably like weeks or months later, obviously, because I'm recording this right now. But this was history being made. I mean, this was just crazy. Look at this. This is unbelievable. I've never seen anything like this before. This big of a ball, like this big of a push right here, and these big, volatility right here. But anyways, that has nothing to do with this video. Let's go back here and let's go to NYC. So as I said, futures, ES, NQ, and YM. So US 30, US 100, and ES is very NYC focused, meaning you'll get that big directional move at New York and NYC open, right? NYC opens at 9:30 a.m. Eastern, right? As you can see right here, liquid grab NYC perfectly. Then we get that move, right? Post liquid grab. So, I mean, you can either break it down here. We can go into details. Let's actually go to replay bar. And let's go to the 30-minute here. But actually the 1 hour looks cleanest. But you can see right here, this is Asia session. So, a small move right here. Then London is setting itself up for a liquidity grab. Then at NYC, we get that liquidity grab, and then we get that continuation post liquidity grab. So do you see how it's either Asia or London session on futures that's setting itself up for NYC to then liquidate that liquidity that generated during Asia or London session? We get that liquidity grab. After the liquidity grab, we obviously get that big continuation post liquidity grab, CCL, continuation, consolidation, liquidity. We can also go over here. You should know this by now. You should be familiar with this now. Continuation, right? Consolidation with price moving sideways, generating buy side and sell side liquidity. Liquidity grab above previous highs, buy side liquidity. Post liquidity grab, we get that continuation, CCL. Right, so I mean, yeah, that's kind of how it corresponds to each pair. We can even go over some more examples here. Let's see. So this was probably news Wednesday, I suppose. No, we're on gold. I'm not even on US 30. What? Not even on US 30, my bad. But gold also gold is also pretty heavy on New York and NYC. I'm not even on US 30 or futures, but whatever. It's the same exact principle, right? You can also see that this was during news, so this can't really count. But yeah, you can kind of see that at NYC, you get that big push, and then after that, New York session, we get that big push again. So NYC typically does get that big push, especially on futures. You can see right here, this is the top wick at NYC, right? Get also this move. Like, there's a lot of volume at NYC, especially on futures, right? We can go back even further here. This was pre-NYC actually, but then this at NYC pushed straight up right here, right? This was, yeah, and right here as well, this is NYC, right? You can kind of get the continuation, consolidation, liquidity, then NYC, boom, right? Do you see this? This is at NYC right here, right? NYC typically brings in the most amount of volume, and when there's a lot of volume, a lot of volatility, we get a lot of liquid grabs. I think this was FOMC. Yeah, it was. This was FOMC on Wednesday, the 18th December. But you kind of get the idea at this point, don't you? This was also NYC right here, liquid grab, or even liquid grab to the downside, and then to the upside, and then we get that directional move at New York session, right? This was also day right before that, get that push right here, liquid grab at NYC. And then if you're confused, my trading view is set to my Central European time. So if you're from Europe, or CEST, so that's Central European summertime, right? Then it's at 3:30 p.m. Okay, NYC is at 3:30 p.m. If you're from the US, it is 9:30 a.m. Eastern. That's why whenever I go on TradingView, it says 3 p.m. down there, 1500, right? But that's kind of if you're confused about it. But you can also go to the previous day, right? Liquidity grab above these highs up here, above all this buy side liquidity. We get that move after the liquidity grab at New York session, right? It goes over and over again, happens over and over again. Look at this, NYC, liquidity grab, right? And then we get that big move at the New York session, right? It happens over and over again. I mean, I'm getting kind of bored, and you're probably doing that as well. But I mean, look at this, NYC liquidating all this buy side liquidity above these previous highs here and here, liquidity grab, NYC, get that move at New York session, right? Go over and over again, right? NYC right here, liquidity grab, and then we get that continuation, right? Post NYC, right? So you kind of get the idea. Futures are heavily NYC and New York orientated. Gold is pretty New York and London orientated. But as I said, if you're trading something up against the yen, it is most likely also Asia session heavy. And if you're trading GBP, USD, it's most likely London or New York, right? You kind of get the idea. GBP, as I said, that's, London, right? London session, US dollar, New York session, kind of get the idea. It's pretty self-explanatory if you really think about it, right? But that's basically how a volume corresponds to each pair. So I hope you guys liked that video, and I'll see you guys in the next one. So combining volume with liquidity grabs. So as I said, the more volume there is, the more liquidity grab there's going to be, because the more volatility, the more liquidity, right? Makes sense, huh? And basically, we want to utilize this because, as I said, it is, it gets pretty repeatable. It gets pretty, like, you can kind of see it over and over and over again with the CCL. NYC is the liquidity. Then after NYC, during the New York session, later on, we get that continuation, right? As I said, right? So once everything is repeatable, or once you can start seeing a pattern, and once it happens over and over again at NYC, which it does on futures, heavily on futures, right? Then it can get real profitable real fast, right? But how do we combine liquidity with volume? So as I said, the more volume there is, the more liquidity grabs there's going to be. And we obviously wait for liquidity grabs to happen, and then we take advantage of that move post liquidity grab. So we don't want to trade Asia session during on US 30 or on NQ or ES. Like, that's just stupid, right? There's no volume. The markets aren't even opened, and it's just stupid, right? You have to obviously, use your head. You can't trade Asia session on US 30. You would be better trading Asia session on USD JPY or something like that, GBP JPY or something like that, right? But anyways, how do we still combine it, volume and liquidity together? So as I said, London typically, Asia and London typically creates that liquidity for New York to liquidate. Okay, now if we go to the 30-minute here and see here, so my initial, let's just go over day by day, and obviously not every single day is a trading day. Day trading does not mean you have to trade every single day, right? And I trade about 2 to 3 trades a week, so I don't even trade every single day. It's pretty, on average, probably trade like every other day. But anyways, let's go back here. Let's go to this analysis, for example. In this scenario, I would, first of all, to combine volume and liquidity, I would first of all look at what the time is here. This is 9 a.m. to 9:30, okay? Pre-market open. Market open, next candle is market open at 9:30 a.m. Eastern, which is NYC. So first of all, I would identify, okay, well, we're in a bearish trend, obviously, right? Look at this, bearish trend, bearish move here, right? Little pullback, bearish move. We're on a little pullback, but it's a bearish move. So then I would, mark out my previous highs up here. This is, let's see here. So London highs are up this is pre NY highs right there. This is the NYC. So Asia highs already got liquidated. These are Asia highs right here that got liquidated in London session, as you can see right there. Then pre NY, so we can just delete this now because that's just gone. I mean, this level is just, you know, gotten broken through. But there's levels up here, and then there's pre New York highs up here, right there, right. Those are the highs I would have marked out. And then obviously for, you know, potential take profits, I would mark out this wick down here. This is Asia lows. So do you see how Asia lows comes in handy whenever I'm anticipating that we will push up first for liquidity wrap because we're in a bearish downtrend, right? And then if we start flipping bearish, we can continue down and target, you know, Asia lows, right? So what I'm anticipating here is that we get something like this, and obviously this is easy set in easy set in hindsight. I could just go over it by replay bar, but I actually took this trade and I remember this clearly, right? So market pushed up at market open. We pushed up a bit here. Let's actually, what the okay, good. I accidentally pressed a bar ahead of time, so let's actually just do it like that, right? We push up here. And we break all these highs up here, right? Now I deleted all my drawings, but whatever. I mean, you kind of get the idea. Asia lows, pre and Y highs there, and pre, and Y highs up there as well. Kind of say London highs right there. But anyways, we kind of push up to there, right? Almost push up to these highs, but still liquidate this. So I would probably get into, or I actually did get into a sell position once the candle flipped. And there's stops up here and take profit at Asia lows. So do you see how we combine liquidity with volume here, right? By knowing which time zone we're in, knowing where the previous highs and previous lows are, and identifying that, okay, well, if we're in a bearish trend, we will most likely push up first, liquidate some kind of liquidity above either previous, either at, what's it called? Pre-NY highs or pre-London highs or pre-Asia highs, but those were down here. So that's just another, like I'll go over another trade where this is not the case, that Asia highs get liquidated in London session. But anyways, we kind of, liquidate pre-NY highs up here and this high right there, right? And then obviously entries right there, and then we ride the wave all the way down to Asia lows, right? And then I don't know what happens on the next day. Yeah, we start rejecting and then pushing down, but whatever, that's the trade anyways. Let's go over another trade here. Let's go over something more clean actually. Let's go to the 1 hour. Let's see here. Should be something way more clean, shouldn't there? Well, I mean, we can go over any of these trades, I don't mind, but I just want to see something with one candle. But whatever, this is fine. Let's go back here. So let's go back one more candle. So first of all, the overall trend is bearish here, right? Look, bearish trend, consolidation, right? Price moving sideways. And this is, let's see the timings here. This was previous NYSE and New York session. As I said, we get that big move. Then we kind of slow down at the end of the day, right? And then at Asia session, this is Asia session right here. We're pretty much doing nothing. Then at London session, we push up a bit, push down a bit, but do pretty much nothing as well. Just, kind of crumble up here, like crawl up here, right? And then this right here is not NYC, but this right here is, let me go to the 30 minutes actually. Yeah, so this right here is NYC. You can see from 9:30 to 10 a.m. So let's go back. And I would pretty much mark out these lows down here for potential take profit, because obviously we take profit at equal lows or previous lows if we're taking sells, right? Because we need to target liquidity. Your entry should be after liquidity wrap, and you should be targeting liquidity as well, right? So in this case, I would mark out these highs. That is pretty much the London close highs right there. So let's say Asia highs. Where's Asia highs? Asia highs is like up here or something, but that already got ran through, so we'll just delete that. And then that's basically it. This is also Asia highs right here, and we pretty much ran all of those highs. And then your entry would be, if we push up here, liquidate this, then start flipping bearish, your entry would be on the candle, and your stop above the liquidity wrap, and you can target Asia session lows. So this is actually London lows in this case, okay? London lows right here, right? So do you see how we kind of use liquidity combined with volume here by utilizing different sessions? So this is obviously US 30. It's going to be different on all pairs, but US 30, NASDAQ, and ES typically works the same because it's all futures, right? But obviously it's different in for example, gold or Euro USD. You just have to, go over, just do it
a bunch of times, and you'll gain experience from it. You'll see patterns. You'll see, okay, on gold it may liquidate previous Asia highs, but then take out London lows or something like that. Like there's so many patterns. It's just a matter of time before you realize them, right? But anyways, the trade would be right there. Do we get that liquidity? Yeah, we get that liquidity grab. Stop loss would be right there. Entry. I remember this clearly as well. This trade clearly as well. This was a good trade. But anyways, take profit was at London lows, not Asia lows, but the trade we went over before was Asia lows. This is now London lows, and we can probably target down there. And yeah, that's the trade right there. And then price starts to reject. Right, beautiful. But anyways, that's how we combine liquidity with volume, right? So volume typically on futures, or like 99% of the time, kick in at NYSE or at New York Open, right? And on gold, it's also New York, London Open, and stuff like that, right? We've covered this in the previous video. But anyways, that's how to combine liquidity with volume. I will see you guys at the next one. I hope you're still taking notes. I hope you're still grinding and watching these videos until the end, because you should be. You should be. And if there's anything you're missing or anything you don't understand, just always just go back and rewatch it. And remember, take some notes. For God's sake, take some notes with a piece of pen and paper or online. Okay, write it down. First watch the video, then write it down along the video, and then kind of just try and implement it on TradingView and on your broker as well, and then you kind of get the idea at that point. It's not easy. Nothing in trading is easy. It is simple, and I can explain this to you step by step. Simple, right? But it's not easy. Nothing in trading is easy, right? Trading is simple, but it ain't easy, okay? Remember that. But anyways, take some notes and watch the videos over again if you don't understand something or if there's something missing, right? And yeah, that's basically how to combine liquidity with volume. I will see you guys in the next video. All right, so liquidity grabs during high impact news, okay? So high impact news means red folder news. You can check on Forex Factory. Today we ain't got nothing. Yesterday we didn't have anything as well. But tomorrow we don't really have anything. But I'm talking about CPI, PPI, NFP, FOMC, stuff like that, right? Typically happens at either 8:30 a.m. Eastern, 10 a.m. Eastern, 10 a.m. Eastern, right? And then FOMC obviously happens at like 2 p.m. Eastern. But anyways, whenever there's high impact news at 8:30, we typically don't get the main push at NYSE, but we get it at 8:30. So the volume pushes back an hour because there's news. And when there's red folder news, that brings in volume. When there's volume, when there's volatility, that brings in liquidity grabs, right? That's typically how it is when you're trading, high impact news. So high impact news works best on Forex pairs compared to futures, because on futures, the market hasn't opened yet because it's 8:30. It opens up at 9:30, but on Forex, it works best. So if you're trading news, which is honestly could be good if you do it correctly, right? Because news typically spikes in one direction, liquidates everyone, manipulates everyone, stops out everyone, and then it moves big in the other direction, right? Just a clear liquid grabs, and then we get that continuation. So if you know how to trade news, it could be very good for you. But just remember, when there's news at 8:30, like CPI, NFP, what's there more? I can't remember at the top of my head. There's PPI, yeah, stuff like that, right? Typically, volume shifts back or pushes back an hour, right? So at 8:30 instead of 9:30 a.m. Eastern. But on gold, I mean, we get that big push at those type of events. So high impact news, red folder news. On futures, it doesn't affect them that much. Red folder news at 8:30, but then 10 a.m. affects futures way more than it does on gold. So thumb of rule is 8:30 news in New York session typically affects Forex pairs the most, right? We get that liquidity grabs and huge volatility, okay? Then on futures, it doesn't affect it that much because market hasn't opened yet, but 10 a.m., however, does. If there's 10 a.m. red folder news, like on Friday of me recording this right now, then that will most likely, impact, price pretty heavily, okay? That's kind of how you want to go with it about trading news. And yeah, well, we will get into another video about some mistakes to avoid trading pre-high impact news, so you don't get caught on the wrong side, because trading news is pretty dangerous if you don't know what you're doing. But we'll get into that. So I'll see you guys in that video. Let's get into it. All right, so some mistakes to avoid when trading pre-high impact news. So let's say that this was today, okay? Today, there is PPI at 8:30 a.m. Eastern, right? So 2:30 p.m. my time, but 8:30 a.m. Eastern, right? I would not trade, I would not trade from 8:15 a.m. Eastern to 8:35 a.m. Eastern, okay? At least a minimum of 15 minutes before the trade, before high impact news, before red folder news, right? 15 minutes before, or at least more than 5 minutes after, okay? Because that's typically when we get that liquid grab. So if it was 10 a.m. as well, I wouldn't be trading after 9:45 a.m. Eastern, and I wouldn't be trading until 10:04, 10:05 a.m., right? For the market to settle down, market stops spiking, all the spreads come down and stuff like that, right? That's kind of how you want to go about it. But typically, also a thumb of rule is pre-news. So if there's some high impact news at, let's say, 8:30 in this case, right? Typically price, starts to die, like volume starts to die down before the news. So it's just setting itself up. So it kind of starts by, let's say that this is just a normal consolidation, let's say a big push and then consolidation, right? This is typically from, if there's 8:30 news, let's say 8:30, 8, let's say that's an ugly 08:30 news, right? And then typically from here, which is, let's say, I don't know, 7:30, right? Typically starts to consolidate to print buy side and sell side liquidity for the news event. So as I said, London and Asia session typically generates liquidity for NYC to push through, manipulate, and then we get that big move, right? Which price does something like that, right? Liquidity grab at NYC, and then we get that big move. Now, as I said, volume has pushed back price now if there's 8:30 news on FX. I mean, heavily on FX. Not that much on futures, but heavily on FX, right? So this will most likely happen at 8:30 a.m. Eastern instead of 9:30 a.m. Eastern. So this typically pre-news price typically consolidates, moves a bit, iffy, like moves a bit choppy, and pretty much just traps everyone before that news event. News event, high impact news brings in a lot of volatility. When there's a lot of volatility, we get a lot of liquid grabs. And then after that liquid grab, we get the continuation and the directional move, right? That's kind of how you want to see it, and some mistakes to avoid when trading high impact news. So be careful when there's high impact news, and rather always be, always be safe than sorry. Rather be safe than sorry, right? Rather not take a trade, rather sit out and watch price do its thing than jump in a bad trade and lose money. Always be safe than sorry, okay? So that's kind of how you want to go about it. Remember, don't trade 15 minutes before red folder news, or at least, more. You need to wait at least 5 minutes, like 4 to 5 minutes after red folder news, for price to settle down and to follow a direction, right? That's kind of how you want to go about it, and some mistakes to avoid, right? So that's basically it. I will see you guys in the next video. Let's keep it pushing. All right, what's good, everyone? So how to anticipate the liquid grab. So now we know about timing, we know about volume in different sessions, in different pairs and instruments, and basically everything about it. But how do we anticipate the liquid grab, and how do we anticipate where it's going to be at and when it's going to be at, right? So typically, as I said, on futures, typically happens at an NYC, so at 9:30. 9:30 to 10 a.m. That's typically when the liquid grabs happen. Sometimes, rare occasions, it happen at 10:30 a.m. Eastern, but most of the time, 9:30 to 10 a.m. Eastern, right? So in this case right here, we got that liquid grab at NYC. You can see right there on the timing below, 3:30 p.m. my time. That's 9:30 a.m. Eastern, right? And where do we anticipate it? Well, if we go back here, as I said, we anticipated to, first of all, we draw out these significant levels. So there's a significant level up here, right? And there's a significant level down here. And then there's kind of this iffy range right here. You can kind of say that there's a level here, something like that, right? There's also a level up there and a level down here, right? And then actually just delete this level in the middle. That doesn't matter. But anyways, let's mark out the liquidities levels and buy side and sell side liquidity. So this is London highs right here, right? We can mark that out. This is this is London close, like New York close highs up here. Let's see, Asia highs are here. That already got ran through right there at London open pretty much. And yeah, that's basically it. So for the the overall trend is obviously bearish here, so I'm looking for a liquid grab to the upside before we get that move to the downside, right? As I said, rubber band effect, price needs to go up before going down and vice versa, right? So I'm looking for a price to either move up here, liquidate London highs, right? And then move down, or liquidate London highs and also these New York close highs right here, right? That's basically it. And then for targets, we can look at this wick right here. This is the previous NYC lows, right? And there's also some lows down there. That's Asia lows that got liquidated at pretty much London session, and then there's London session lows right there, right? That's basically it. So buy side liquidity right there, sell side liquidity here and here. Now, as I said, because we are in an overall bearish trend, I'm looking for a liquidity grab to the upside, and then we get that move to continue down. And if we were to draw it in circles right here, this is the continuation. I think this was FOMC. No, this was just NYC. Look at this. This is just so volatile, bro. NYC is always so volatile. This is the continuation in CCL. This is the consolidation, price moving sideways. Then I'm looking for a liquidity grab up here or up here. And then after that liquidity grab, we get that continuation. So do you see how I'm pre-planning the entire move before it's even happening? And I know this is said in hindsight, obviously, but I mean it's the same thing every single day. It happens over and over again, so it's nothing new, it's nothing special, right? But anyways, I'm expecting a liquidity grab up there, and I'm expecting once we get that liquidity grab, we'll probably flip bearish and reject it, and then we can continue down. So the wick is either going to be up here or it's going to be up here. That's kind of how I'm anticipating the liquidity grab it's going to be at and when it's going to be at. So NYC opens up right now. This is actually from 9 a.m. to 9:30. So this was pre-NYC. Then NYC strikes. Let's see what happens. Boom, push up, liquidates these highs up here, this red line, and then we start flipping bearish and continue bearish, right? Now, your entry would probably be on the candle flip right there, 30-minute candle flip, stop loss above the liquidity grab. And you can target these London session lows down here, or these previous NYC lows down here, and these previous daily lows if we go to the daily time frame as well, right? That's basically how to anticipate the liquidity grab with timing, with pairs, with sessions, right? And everything about it. So I hope you guys like that. Hope you guys are taking some notes and enjoying it. But anyways, that's basically it. What even happened after this? Did price start to reject, or would we just push straight down? Damn, crazy, huh? Crazy. But anyways, I will see you guys in the next video. Take care, and let's keep it pushing.
So I hope you guys liked that chapter about the volume and the sessions, and now we really dig in. We really go in depth about everything. I mean, top-down analysis, market structure, some timing techniques, again with entry, timeframes, risk management. Bro, there's so much good stuff, right? So stick around, keep watching, and I do want to, mention that if you watch it, until this point in the video and you're this deep into the video, I am assuming that, you are dedicated to trading and you really want to make this your career. You want to achieve financial, time, and location freedom, and I can help you with that, right? If you are dedicated to trading, like really dedicated, you can apply for my one-on-one mentorship where you get, profitable guaranteed, right? It's fucking crazy. You can watch the video in the description. Make sure to do that and apply below, bro. It's unbelievable. But if you aren't if you aren't dedicated to trading, I don't want to work with you. I only want to work with 100% motivated, 100% dedicated traders that actually want to change their life with trading. So if that's you, if that sounds like you, go apply below. Watch the private training video. And yeah, I hope you guys like the next chapter and the last chapter where we go we go in depth about everything. I hope you guys enjoy. So I'll see you guys inside.
What is good, everyone? So in today's video, I'm going to be breaking down how to combine liquidity grabs with top-down analysis, which is an absolute must in order to become profitable. You have to understand how to read the markets from top to bottom, top to down, like top-down analysis, right? But it is not just top-down analysis. You also have to understand how to gather the information from each and every time frame, because every single time frame tells a certain story, and every single time frame has its own story behind that, right? So I'll get into all of this within this video. Don't worry, just watch the entire video. But anyways, I'm going to be going over the 1 hour, then 30-minute time. This is all the same price action, by the way, exact same price action, right? But there's different layers to this by understanding each time frame top-down analysis, right? I'll get into all of this. I'll also get into a trade recap where I made over $6,000 in about 4 minutes trading top-down analysis combined with liquidity grabs. So don't worry, everything will be covered in this video. And this is basically the video you'll ever need, like the only video you'll ever need about top-down analysis. So I hope you enjoy, take some notes, and watch the entire video, and let's get into it. All right, so a thumb of rule here is that we use the higher time frames for direction and bias. So that means the weekly daily, 4-hour, and 1-hour for direction and bias, and looking at the higher time frame overall trend, right? Then we use the 30-minute, 15, 5, and 1 minute to identify the best possible entries and exits and risk management during the trade. But I'll get into this as well, don't worry. So right here, we've got a 1-hour time frame price action, 3 1-hour candles. That's obviously 6 30-minute candles, 12 15-minute candles, and 36 5-minute candles. I'll go over this, don't worry. But anyways, here's basically just 3 bearish candles. It is pretty straightforward, right? A bearish candle, another bearish candle, but this is kind of not that strong, so it's most likely moving sideways on the lower time frame. Then there's a liquidity grab breaking previous high right here, then the continuation. And if we go to the 30-minute, it's the exact same thing. 2 30-minute candles right here. That's the 1 hour, close down here, exact same price action. As I said, all of these time frames are the exact same play, just different time frames, right? But anyways, if you're not familiar with the CCL, there's only 3 phases in trading, okay? The market can only be in one of these 3 phases, and then it repeats itself. It is a repeatable process, and when something is repeatable, you can take advantage of it and make a shit ton of money with it. Now, as I said, there's only 3 phases to the market. There's the continuation. I'll draw it out right here, continuation. Then there is the consolidation. Then there is the liquidity, so CCL, and then it repeats itself. CCL, 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 right? Just repeats itself basically. So CCL, continuation, consolidation, liquidity, and then after the liquidity, we get the continuation again, right? That's just the 3 phases. Like the market can only be in this, no matter which time frame, no matter which session, no matter which pair, no matter which instrument, everything is CCL, right? Now, the first C is obviously the main push, the overall higher time frame. Then the second C, consolidation, is whenever price is moving sideways, generating buy side and sell side liquidity. Then we get that liquidity grab, breaking, most likely following the higher time frame trend. So in this case, breaking buy side liquidity right here, grabbing buy side liquidity, then we get that continuation post liquidity grab. Now, if you're trading ICT, you may be familiar with this because he calls it distribution, accumulation, manipulation, then distribution. But I just simplified way more than that. It's the exact same thing. Okay, I'm not here to copy anything, and he didn't copy it. Like it's not his thing. Like, it's not his whatever, right? That's just how the market moves. Everyone should know this. And by knowing this, by knowing that it's repeatable, you can make a lot of money and become profitable. Now, as I said, 30-minute time frame, or get that first initial push right here. Then price starts retrace with this bullish candle right here. So this is basically moving sideways. Whenever price is moving sideways, as I said, it is generating buy side up here and sell side down here because there are resting stop losses. Stop losses equals liquidity. Liquidity equals money. What does price want to do? What does market want to do? It wants to hunt the money above or below previous highs and lows, or equal highs and equal lows, right? So it pushes up at market open, typically happens at market open or pre-market open, liquidates buy side liquidity, and then we get that move. Now, this is the 30-minute time frame, and this is the 1-hour time frame. Look at this. Broke previous 1-hour high right here, right? Broke the two previous 1-hour highs right here. Exact same price action. Now, if we zoom down to the 15-minute, you'd have to understand that these candles and this candle right here is literally just a consolidation, aka accumulation, or like a sideways moving thing, right? It's just a consolidation phase. Whenever price is moving sideways, it's generating buy side and sell side liquidity. Sell side liquidity down here, buy side liquidity. Liquidity equals stop losses equals money, right? Remember that. Now, at market open, this is not one candle because this 30-minute candle is obviously one candle, but on the 15, a wick on the high time frame is just a candle closure on the lower time frame. So a wick on the 30-minute time frame is 2 candles on the 15-minute time frames. Funny enough, right? But on the 15, it's not just a wick. It's not just this wick. It is 2 candles, a bullish candle with a rejection here, and then a bearish candle after that closing down here, aka closing down here. Now, if we zoom down to the 5-minute, right, this is where we want to get our entries. Now, if we go to the 5-minute, as I said, it's the exact same price action, all of these time frames. This is basically the push, consolidation right here, liquidity, and then push again. So CCL, right? I can even draw it out here to explain further. C, right? Then the next C, consolidation. And then we get that liquidity, right? On the 5-minute, it is also just closures because at the higher time frames, it's wicks, but on the lower time frames, it's closures. And after that liquidity, we repeat itself. So continuation again, continuation, consolidation, liquidity, continuation, consolidation, liquidity. That's how you want to take advantage of it, right? So above, you have to understand that there's 2 forms of liquidity as well. There's liquidity above or below previous highs and lows, and there's liquidity above or below equal highs and equal lows. In this case, on the 1-hour time frame, it is above a previous high up here. There's buy side liquidity up here. But on the 30-minute time frames, it's equal highs, right? On the 15-minute time frame, it's also equal highs. Look at all these highs. It's at the exact same level right there, equal highs. On the 5-minute time frame, there's also equal highs here. Then price at market open pushes up, liquidates that, manipulates, stop hunt, whatever you want to call it, and then we get that move to continue down. And you may ask, why does price want to manipulate or liquidate early sellers, right? Obviously, because everyone basically got in right here, stop loss up here, take profit down here, because this looks like a break and retest, right? A break, oh wait, that was my mistake, break, retrace to this level, rejection, everyone gets in sells right here, the market traps everyone has their stops up here, aka that's where the most liquidity is. Liquidity equals stop losses equal money. Is price going to shoot down here? Most likely not. It'll most likely shoot up first, liquidate everyone, and then shoot down, right? Happens on every single time frame, every single pair, in every single session. Now, it's most likely going to happen in a more volatile session, obviously, because the more volume there is, the more liquidity there is, right? That obviously makes sense. But if we go to the 15-minute, everyone most likely has their positions right there, stop loss up here, and take profit down here. Is the market going to shoot down? No, it's going to shoot up first, manipulate them, and then it's going to shoot down. And that is what we want to take advantage of. So instead of entering right here and getting stopped out, we enter post liquidity grab, and then we take advantage of that continuation post liquidity, right? I hope that makes sense. So instead of entering here on the lower time frames, this is the exact same entry on 30-minute, 15-minute right here, and then the 5-minute right here, right? Instead of entering here with the stops up here, then you get liquidated. We take advantage of that move post liquidity grab. So we enter right there with the stops above the liquidity grab, because if the stops were to get broken, the trade is no longer valid. The stops are placed at a logical levels, because if price wants to break that, you know, it's most likely not continuing down anyways. And then we take profit at a significant level, or at equal lows or equal highs, or below or above previous highs and previous lows. That is how you want to take advantage of top-down analysis. Let's go over a trade recap where I did this, because I do this every single day, and I've done this for 2 to 3 years now. And yeah, where I made over $6,000 in 4 minutes trading this exact top-down analysis combined with liquidity. So I hope you hang on here. I hope this is starting to make sense. But trust me, it will eventually. Let's get into the trade recap. I'll see you guys over there. All right, so here's the trade. This is basically taken off the 5-minute time frame, right? But we use the daily, 4-hour, 1 hour for direction and bias, and basically also the weekly. But I could already see on the weekly that it was bearish because of daily, right? And then we use the 30-minute, 50-minute, 5-minute, and 1 minute for entries, right? This was a beautiful textbook A+ setup. Now, this trade looks pretty familiar with the price action we just saw, because I got inspiration to do that video, because I've got a lot of requests on how to do top-down analysis, how to combine liquidity grabs with that, with the higher time frame, etc. So let's go over this trade real quick here. Let's delete this level. Now, let's actually go to the daily time frame, right? The annoying thing about TradingView is that it can't really pause its time, so this ended up pushing up, but just forget that, right? But anyways, this is a overall bearish trend. You can look here. We can even go back a few bars here. Overall bearish trend, pretty easy to see. If we go to daily, it's also bearish. If we forget the daily candle right here, if we go back a bit, 1 bar right here, it's bearish, right? The overall trend is bearish. Hence, I'm taking sells, because it's more likely to go down than up if you're in a pro trend versus counter trend. If you go to the 1 hour as well, bearish trend. It's pretty easy, right? Now, if we go to the 30-minute, let's actually skip ahead here. This is the annoying thing about TradingView replay bar, but it's fine. It's fine. If we go here, right? This is let's go to the 30-minute right here. This is a overall bearish trend. This right here is the continuation, as you can see. Continuation bearish. Now, this is the consolidation right here, where price is moving sideways. Whenever price is moving sideways, it's generating buy side and sell side liquidity, aka stop losses, aka money. Now, at market open, this was taken at 9:45, so yeah, 15 minutes after market open. And at market open, is price just gonna shoot down? Most likely not. It's most likely gonna push up, liquidate this, manipulate that, and then push down, right? But I'll get into that here in a second here. So if you go to the 30-minute, now, do you see how I use the daily, 4-hour, and 1 hour for direction? Bearish, right? Now let's delete all these levels as well. Let's just delete everything. Now I go to the 30-minute to identify my significant levels. There's obviously a level right here. Look at all these rejections. There's a level up here. Look at all these rejections up here. There's a level down here. Look, this rejection. And there's a level, let's go to the left here. Let's zoom out. There's a level down here, right? There's also, you can kind of say, equal lows down here, which is what I'm targeting, right? So that's my potential take profit if price were to push up here and then flip bearish, right? Now, this is, let's see here. This is market open actually, 9:30. Like this is the 9 a.m. to 9:30 candle, right? So market opens right now. And I'm anticipating that price wants to do something like this. If I were to draw it out as well, push up, and liquidate this buy side because there is buy side liquidity resting above these stop losses or these wicks up here, right? Because liquidity equals stop losses equals money. Because most traders has most likely gotten into sell positions right there after this rejection because it is an overall bearish trend, right? But their stops are up here. There's equal highs up here. There's two forms of liquidity, above or below equal highs and lows, or above or below previous highs and previous lows. They're pretty much anticipating this move right here. Well, what happens? We're on the 5-minute time frame right now. Market opens, shoot directly up. That's like 100 pips already within these first 5 minutes. Then the next 5-minute candle pushes all the way up here, liquidates everyone. So all the early sellers got liquidated. And now we want to step in, right? When everyone has gotten out, we want to enter. That's basically how you want to see it, because 99% of traders are unprofitable. So just do or just don't do what 99% of traders are doing, but do what the top 1% is doing. They are waiting for the 99% of traders to get stopped out and then entering, right? So now the entry is taking right here on the 5-minute time frame. You could also zoom down to the 1 hour. You can see a clear break of structure, push up, bearish candle, break of structure down here. Clear textbook play, right? Stops up here, right? And then we target sell side liquidity down here at these equal lows, which are marked out to the left of us, right? It is a textbook play, but do you see how the 15 just closed right here? No, the 15 is still open, my bad. The 5 just closed, the 30 is still open, the 1 hour is still open, and I'm anticipating we will get a bearish flip to continue down, right? The 15 is still open at this point, remember that, right? So what happens? Well, price just instantly shoots down, take profit hit, and that's basically, if we go to the 5-minute, this is the annoying thing about trading view. I mean, it can't pause time. It's just, yeah, but whatever. You kind of get the idea. We just shoot straight down, right? And by the way, this is not just some hindsight trade. I've got proof of everything, proof of live account, proof of withdrawals, proof of bank statements, and I trade live every single day as well. Don't worry, I didn't just go back and replay bar just to show you guys this. But this is what I mean about top-down analysis and how to use the daily, 4 hour, 1 hour for direction and bias, and also weekly, and then the 30-minute, 50-minute, 5-minute to identify the buy side and sell side liquidity, and then take advantage of that liquidity grab post, or I mean take advantage of that continuation post liquidity grab, and that's basically what we did. What's good, everyone? So this is how to combine market structure with liquidity grabs, okay? So this is the theoretical way of market structure and how it prints, right? This is the theoretical way. Remember that, theoretical, okay? It's not going to move like this, but this is how it moves on paper, right? If you were to draw it or write it down, right? And it's going to be more choppy, more realistic, and more all over the place when you see it in real time. But this is the theoretical way of market structure, and you should know this by now as well. It is a clear in a bullish trend, high, higher, low, higher, high, higher, low, and higher, high, right? In a bearish trend, it is a low, lower high, lower low, lower high, and lower low, right? That's just how price moves, right? Theoretically, it's also how it moves, but it moves more choppy. It moves more like it's probably going to shoot down a bit, then it's going to shoot up, and then it's going to shoot down, and then do something like this, then a mini liquidity grab within a liquidity grab, and then something like that. But the idea is still there, right? It is a low, lower high, lower low, lower high. This is where everyone gets trapped in, right? All the retail traders see this rejection of this significant level right here. Let's make it purple, right? Significant level, rejection right here. Everyone gets in sells, right? If everyone gets in sells with these stops up here, is the market going to shoot directly down? No, it's most likely not. The idea is still there because they're taking advantage of this lower high, right, in a bearish trend. So the idea is still there, but it's missing liquidity grabs, right? That's where liquidity grabs come into play. So because there's stop losses up here, because there's two forms of liquidity, above or below previous highs and previous lows, and equal highs and equal lows. In this case, above previous highs. So there's liquidity up there, aka stop losses, aka money, right? Price is most likely not just going to shoot down and everyone makes money and the market loses money. No, it's going to shoot up, so everyone loses money and the market makes money, right? And then it's going to move in that continuation post liquidity grab. So you can also draw the CCL right here. This is the C. This is the another C consolidation, and then this is the liquidity right here, right there. And this is the continuation post liquidity, right? I know there's a lot of drawings right here, but that's basically market structure combined with liquidity, but there is layers to this, okay? So if we were to go on a bullish example, let's actually make this a bit mid-screen, yeah, something like that. Price is most likely not just going to reject this area and shoot directly up. No, it is realistically not. Let's say that there's a significant level right there, and let's say that price starts to reject right here, right? Now, if price was this easy to read, and if price did this every single day, everyone would be a millionaire and everyone would make money, because this is how 99% of traders are taught, and this is how basic market structure is. Everyone knows this, right? A breakout of a significant level, in this case, this is the significant level, a retracement to that significant level, a rejection of that significant level, everyone gets in buys here, stop loss here, take profit up here, everyone wins, everyone makes money, everyone becomes a millionaire, everyone becomes profitable. But that's not the reality of it, right? 99% of traders never become profitable. 99% of traders never make it because they're trading this way. And now this is not how price is going to move here. Price is not going to move like this, okay? It is going to reject here. And then everyone thinks that, okay, well, it's a break, retracement, rejection, right? It is a high, high, low, and I'm anticipating this high, high up here, right? So everyone gets in buy position, stop loss down here, stop losses equals liquidity, liquidity equals money. Is price going to shoot up and everyone makes money? All the institutions, all the retail traders makes money? No, it's most likely not going to do that. It's most likely going to push down, liquidate sell side liquidity in a bullish trend, buy side liquidity in a bearish trend, and then it's going to shoot up post liquidity grab. Okay, so the continuation post liquidity grab. So this becomes the continuation, the hard push. This becomes the consolidation where price moving sideways, and this becomes the liquidity grab. After the liquidity grab, we get that continuation again, CCL, right? But I could also go over it by looking at the higher highs and higher lows, right? So let's draw this. So this is a high, higher low, right? Higher high, higher low. This is where everyone thinks that this higher low is going to be at. Well, is it going to do that? No, it's most likely going to trap out everyone. So first of all, start rejecting. So it's going to trap everyone into taking buy positions right there. And then it's going to most likely align with a market open, right? If that's London open, New York open, or NYC open, it is most likely going to align with the market open, right? So at market open, we shoot directly down, liquidate this. All these early buyers that got into sell, buy positions right there with these stops down here, they got ran through, manipulated, stop hunted, liquidated, and then we get that move and the continuation post liquidity grab, right? And in a bullish trend, we would like to see sell side get liquidated first, right? So sell side is liquidity below previous lows or at equal lows, and buy side liquidity is liquidity above previous highs or at equal highs. Okay, so in a bullish trend, it makes sense to liquidate sell side liquidity first because we are in a bullish trend. Remember that. So everyone that had their buys up here, they got ran through right there, and then we still move in that bullish direction, right? So do you see this, right? So it's in bullish trend, and most likely we will see a liquidity grab to the downside in the bullish trend, trapping out early buyers, right? Stopping them out, and then moving following that overall daily or higher time frame direction, right? And now this was not the higher low. Yes, there's a high, higher low started to reject, so everyone got in. But this now becomes the higher low on the higher time frame. Is that, if that makes sense, right? So this higher low failed because there was no liquidity grabs. Now, this is all theoretical. Price is not going to move this clean. It's going to look more choppy. It's going to look more confusing, quote unquote, in real trading. But I've just uploaded some, there are some live trading videos where I go over this because I literally trade with market structure and liquidity every single day, and that is what you need to do as well, right? So first of all, market structure and price action is the exact same thing. Okay, I may refer to it as price action in some videos or market structure in other videos. It's the same exact thing, right? It's just how price moves, and then we need liquidity as well and combine it together, and then we can make a lot of money, right? But I would suggest you going over the live trading sessions as well, because there's a ton of sauce in there about basically how I use it in a live trading scenario, right? And there's also trade recaps where I show it as well, but it's going to be more choppy than this. Okay, this is the theoretical way, right? This is obviously easier said than done, but once you start implementing it into yourself, and it's going to take time. Remember, everything takes time to learn, and Rome wasn't built in a day. It's going to take time. It's going to take time to master, to learn, to figure out, and to make it click for you, right? But once it does, it is all worth it. Trust me, you'll basically become free, and then you have to fix your psychology, strategy, entries and exits and stuff like that. But this is basically how to combine market structure with liquidity grab, and that's basically this video for now. So I hope you guys liked it. I will see you guys in the next one where we talk about taking pro versus counter trend trades, and yeah, I'll see you guys in there. What's good, everyone? So this is about taking pro versus counter trend trades. Okay, so first of all, thumb of rule, I think 90 to 95, if not even more, of my trades are pro trend. Okay, there needs to be a lot of confluence, double confluence as well, double liquidity grabs in order for me to take counter trend trades. But pro trend trades will almost always beat counter trend trades. It is much easier to take advantage of the trend, basically follow the trend, ride the wave, instead of trying to, in this case, catch a falling knife down here, right? Because otherwise you will most likely get cooked and just get ran through like this, right? It's much easier to ride the wave like you're surfing or something, instead of falling and catching knife or trying to, sell at the top or something, right? So, taking pro trend trades and also matches, it also aligns with the market structure we just went over, right? In a bullish trend, high, high, low, higher, high, high, low, rejection, traps everyone, buys right there, stop loss here, take profit up here, right? Pushes down, liquidate sell side liquidity, and then starts repeating and repeating the CCL, right? So liquidity, continuation, right? Continuation, consolidation, liquidity, continuation, right? It also follows the higher time frame because price almost always wants to follow the higher time frame. If that's the daily, 4 hour, 1 hour, even maybe weekly time frame sometimes, right? It most likely always will want to follow the higher time frame. And if you think of it statistically as well, if it was, let's say that this was a bearish daily candle closure like this right here, right? There is a 75 to 80% chance that the next candle, next daily candle also will close bearish, right? So are your probabilities with you or against you if you follow the trend, if you follow the bearish trend and take sells? It is obviously with you, right? 75 to 80% chance that the next will continue bearish. So it's much more easy to take sells or to just take, pro trend trades in general compared to counter trend trades, right? So I always suggest to take pro trend trades and don't start taking counter trend trades, right? Don't do that unless you're very, very advanced. But I just wouldn't even do it. Like I rarely even do it these days, bro. Like I probably, it's more than 95% of my trades that's pro trend. It's more like 98 probably or something like that. Like it's very, very, very rare that I take counter trend trades. And the good thing about pro trend trades is also that there is room for runners. So if we put this into perspective of the market structure again, let's put a bearish example this time, right? The low, lower high, lower low, lower high, and then a lower low. We're anticipating this entire lower low right here, right? Obviously, this is not the move. This is probably the move right there, right? Post liquidity wrap. But we're anticipating this entire move right here. And if we are taking sells here, post liquidity wrap, stop loss up here, take profit down here, we can have runners because it's following the overall bearish direction. If this was buys, and let's say that the overall the overall direction is bearish, but I'm ending, I end up taking buys, let's say something like this, right? I take buys right here after this liquidity sweep to the downside, right? But it's still in the bearish trend. So now it's a counter trend trade, right? Stop loss here, and I can't have runners up here. I just can't. It doesn't make logical sense. This will most likely never be hit, right? Price will most likely still, because it's in a bearish trend, will most likely just push up to here, liquidate this, and then start retracing, like rejecting, right? So as you can see right here, this is still a low, lower high, lower low, lower high, but this never broke these lows down here. So this doesn't become a lower low down here, right? This is not a lower low. This is just a mini lower high within this consolidation range, kind of. And then this becomes the lower high, right? Instead of here, right? And then this becomes the lower low. So it's like, it's much more complicated in terms of price action and market structure combined. Like that's the same thing, right? Combined with liquidity grabs, it is much harder to take counter trend trades and have runners and have good positions and let it run a bit to make some profits than it is to take pro trend trades. Because pro trend trades, you follow the rate, you follow the trend, you ride the wave, and you can have runners because you're anticipating the new lower low. I mean, in a counter trend trade, you never know where the high is going to be at, or the new lower high in this case, right? You thought that it was right here, then you switch your bias to bias, right? But then it ended up being right here because we never broke these highs, right? Even if you had to take profit up here, that never got hit, right? Because it still wants to keep itself under this high because it's a lower high in a bearish trend, right? It's basic market structure, but there's liquidity grabs within the market structure, right? That's why taking pro trend trades is much, much, much easier than taking counter trend trades. If we go over the CCL here, this is also linked, by the way, inside the web platform. You can also see that this is pro trend, right? This is pro trend, and it's much more likely that the liquidity wrap is going to happen pro trend versus counter trend. It is more likely to have a sell side liquidation in a bullish trend than vice versa. And it's more likely to have a buy side liquidation in a bearish trend than vice versa, right? Because it's following the overall bearish trend, right? So this becomes a low down here, lower high right here. That's at least what everyone thinks. But this is the lower high, then this is the lower low, right? And vice versa. This becomes a high up here. This becomes a higher low. That's what everyone thinks, because this high is, this is higher than this low, right? But this ends up being the higher low, and then this is the higher high, right? That's kind of how I see it and how I go over it by taking pro trend trades versus counter trend trades. So always, just thumb of rule, always stick to pro trend trades. It's much easier to catch. It's much easier to catch bigger positions and bigger trades and get bigger profits, because you can ride the wave and follow the overall higher time frame trend, right? So that's the video for now about taking pro versus counter trend trades. I hope you guys like that. Let's get into the next one and let's keep it pushing. I'll see you guys in there. Hi, what's good, everyone? So which time frames to use for entries and exits? So first of all, I just want to add something to the latest video about taking pro versus counter trend trades. Look at this prime example. I literally just scrolled past the chart here. Look at this bearish trend, right? But we start pushing up here. Now, is the overall trend bearish? Yes. So are we going to take buys? No, right? This is a clean as liquidity grab at London Open, right? Exactly like at London Open. Aligns perfectly, equal lows down here, like almost equal lows, liquidity grab. And if you didn't know about, taking pro trend trades or the top down analysis about higher time frames, you would have been in these buys right here. It looks clean, right? But what happens? Well, it's most likely going to follow that overall trend, and this liquidity grab is useless basically, right? And it just shoots directly down at market open, right? And you can kind of see it here, liquidates this previous high. Even though it's 2 candle closures, it still liquidates previous high, because if you were to go on the 4 hour, it probably, let's see here, I can't even see it, but if you go to the 2 hour, wicks are basically, okay, wow, 3 hour, candle closures are pretty much just wicks on the higher time frame, right? So this is pretty unusual because it's the 3 hour. I don't even trade this, but you kind of get the idea, right? Body closures, as I said, it's literally just wicks on the higher time frame, right? So it's just 2 candles on the 1 hour, but it's a wick on the 3 hour. This typically tends to be, candle closures on the 15-minute, 30-minute, and then wicks on the 1 hour or 4 hour. But you kind of get the idea, right? This liquidity grab was basically useless, right? Because it's an overall bearish trend, heavily bearish. You're taking pro trend trades, aka it's most likely not going to work out, right? And then you can, if you take sells here, look at all these runners, potential runners all the way down here. But anyways, that wasn't about this video. This video is about taking, or like what time frames to use for entries and exits. So what works best for me with this strategy, based off my 3 to 4 years experience with it, is that first of all, we use the weekly, daily, and 4 hour and 1 hour for direction bias, and ideally 30, 15, and 5-minute for entries, right? But I tend to see that the 1 hour, 30-minute is the absolute best for this, strategy, because as I said, it is most likely just candle closures on the 1 minute, 5 minute, 15, and then wicks on the 30 and 1 hour. And liquidity wicks are way easier to catch, way easier to spot than candle closures, right? So from my experience, it's the 30-minute and 1 hour, but also do use 15-minute and 5 minutes sometimes. Very rarely, if not never, basically use the 1 minute, right? But 5 minutes to get a better possible entry. Sometimes you'll see this on the trade recaps and the live session as well, but mainly 15, 30, and 1 hour, mainly 30 and 1 hour, right? That's kind of what I use for entries, right? Because as I said, 15 closures, I went over this in the top down analysis. You should know this by now, but candle closures on the low time frames are literally just wicks on the higher time frames, right? You should have seen that video by now, because it's linked above. If you didn't see that, you skipped the videos. That's not good, bro. Trust me, you can't skip these videos. We need to watch all of them to make it work, right? But anyways, that's for entries, right? So first of all, as I said, follow the overall trend, wait for a consolidation, wait for liquidity grab, follow the overall trend, right here, and then use the 30 or 1 hour for entries, maybe in the 15. If you really can go down to the 5 minute and it's clean on the 5 minute, as I said, price is fractal. And what do I mean by that? That means that this strategy is going to apply on all sessions, all strategies, all time frames, and all pairs, right? But it's going to work better, on futures or on high volatility pairs, right? It's going to work better at 9:30 a.m. Eastern. So NYC, it's going to go better with, if you're trading only 1 pair, 1 to 2 pairs in total instead of 30, because you'll see it everywhere, right? So obviously, it is fractal. Time is fractal. This can happen on all time frames, your entries and exits. but based off my experience, it happens most like it happens more frequently and more often on the 1 hour and 30 minute in terms of liquidity wicks, in terms of the entire playbook, right? This move will most likely happen on the 15, 30, or 1 hour, most likely 1 hour and 30 minute, right? And I rarely ever take trades on the 4 hour as well, but I use it for confirmation, higher time frame bias, right? But that's kind of the entries. So 1 hour and 30 minute. If you really see it, if it's really clean, sometimes 15 minute. If you're trying to get a better entry and anticipate the liquidity up, then the 5 minute, right? But yeah, and then for entries, or I mean for exits, it is basically you're exiting it at liquidity levels. So in this case, you would probably, let's just say theoretical, because I don't want to find another example. I can do this after this, but let's just use this example for now. Let's say that this is the 30-minute time frame. You would enter on either, like there's 4 entry types, right? Candle flip. So whenever the candle goes from, you know, in this case, bullish to bearish. So right here, right? And then you can enter, there's a break of current, like, oh, break of previous comes first, right? Break of previous low down here, or high, right? High or low, right? High in a bullish example, low in a bearish example, right? Break of previous low down here, right? So your entry would be there, right? Break previous low, stop loss above the liquidity wrap, always, right? If you can, then you can use the lower time frames for better stops, but most likely, ideally, above the liquidity wrap, because if that were to get broken, the trade would just most likely continue up and it would be unvalid, right? So as I said, either candle flip right here when it goes from bullish to bearish in this example, in the bearish example, and vice versa in the bullish example, when it breaks the previous low, right? Or if it breaks current low. What do I mean by that? So if a candle, let's draw this out as well. If a candle closes like this, right? Next one pushes up. No, next one pushes down first for mini bottom wick, right? And then pushes up, right? This. So it has this kind of wick now, right? And then it starts flipping bearish again. So let's actually do something like, how can I draw this? So it starts doing something like this, right? So whenever it breaks this current low right there, right, that's your entry. So it's, you know, a few pips before the break of the previous, but in some cases, this wick is way down here, and it would make sense to take it right there on the break of the current, right? Stop loss up here, obviously, take profit, new lower low, but that's the break current. And then there's the impulse entry as well. There's the, yeah, that's the break current, and then there's the impulse entry as well. That's just whenever a caddy, you know, a body closure respecting a level, and then we get that break previous. An impulse entry is basically just a break previous. It's just basically the same thing, right? There's just a body closure right here respecting the higher time frame trend, right? So it is a let's draw it out here. It is a continuation. Then there is a consolidation, right? And then there's a liquidity, right? And then we get that continuation post liquidity, right? And but an impulse entry is basically just a break previous, but with a what's it called, like bearish closure above this level, indicating next one pushes down, liquidity up, and then up, right? Basically the same thing as break previous, right? But that's basically the entries and exits. Let's actually go over another example so we can go over the 30-minute. Let me just find one here, or the 1 hour. Let's see here. I mean, there's one up here, but I can already see that that's not that clean. We grabbed all this buy side liquidity, but that's probably a 4-hour trade, just based off my experience and how I see it. Let's see here. There's one down here, but that's also a 4-hour. There's one right here. That's the 30-minute. This is an input entry, by the way, perfectly aligned, right? Break above significant level. As I said, as we went over in market structure combined with liquidity wraps, right? Everyone thinks that this is the higher low, like this is the higher low right here, right? Because it's respecting this level, right? And they get into bias right there or something like that, anticipating new high highs. What happens? We push straight down. Why can't I delete this now? We push straight down, liquidate previous lows, liquidity wrap to the upside, and then it's an impulse entry, right? Exactly the same as here, right? So closed above, right here, first candle, closed above. Second candle, bearish closure, but respecting this level. Bearish closure, but respecting this level. Next one, pushes down, breaks previous lows, right here, liquidity wrap, right? Break previous low, liquidity wrap. Your entry would then be right there. Break previous candle high right there. Stop loss down there, anticipating a move to continue with a higher time frame trend. So a higher high up there, right? You can either we can either place your, I can't drag this. Either place your take profit at a 1-to-1 at equal highs up here. That's Asia highs. That would make pretty much sense. That, like, pretty good logical sense. I would probably close there. Or you could also have runners because you are taking pro trend trades, right? Remember, pro trend always beats counter trend. So in pro trend trades, pro trend like market structures, you can always have runners if you'd like, but I would suggest closing off liquidity levels still, right? So entries, as I said, it's basically the 30-minute, 1 hour, most ideal. You could also go to the 15, 5 minutes, sometimes use the 4 hour. But entries, I mean exits, are then at previous highs, previous lows, or equal highs and equal lows. Typically Asia or London session highs or lows, right? In this case, I wouldn't have runners up there. I would just close right there, 1-to-1, 80+% win rate, super, super profitable, right? Shut directly up within one candle, right? So, okay, now we went back here. That's kind of it about entries and exits. Exits, remember, you need to exit logical. First of all, you need to enter logically, right? Enter post liquidity wrap. Second of all, your stop loss needs to be placed at a logical level. You can't just place it, half, like 50% of the liquidity wrap or something. It doesn't make sense. Like, it just, like, it doesn't make sense, right? You need to place it either below a liquidity wrap or go to the lower time frames and then place it on some kind of internal liquidity wrap. So let's say that there was some kind of liquidity wrap within a liquidity wrap down here or whatever. But just thumb of rule, place it below the liquidity wrap or above the liquidity wrap in a bearish trend, and then target liquidity as well, right? Target equal highs, target equal lows, or previous highs and previous lows. And that's it for entries and exits, right? Everything will make sense once you watch the live trading examples and the trade recaps as well. And once you start using it yourself and implement it into your own trading, right? So it's going to be good. It's going to be good. Let's keep it pushing. We are on a streak right here. So it's good. It's good. You're locking in. It's good. It's good. It's going to make sense eventually. Trust me. Yeah, I'll see you guys in the next video. All right. What's good, everyone? So how to manage your risk in drawdown, right? So I use something that's called hard stops, and then I use soft stops. Okay, and hard stops is basically just the stop, like the hard stop loss, right? Soft stops is where we'll most likely manage our position, right? And this is super crucial. It really is. This was a trade we took here. In this example, I had hard stops down here, right? But I also had soft stops here. So I would close 50% or 75% of my position at these soft stops, right? Because technically, yes, it's logical to have stop loss down here, right? But if it were to break, activate us here and then break these lows, there is not, the favor is, it's not against us, but it's lower. There's a lower probability of the trade playing out and doing something like this, because this is pretty unusual, right? Then we would most likely continue down here, right? So by having hard stops and soft stops, you could basically manage the soft stops in drawdown and lose less than you anticipated. But that's because that's the goal with it, right? You want to lose less than you're anticipating. And if price triggers you in and then goes instantly in drawdown and breaks structure to the downside, there's probably something wrong, right? You have to realize that, okay, well, maybe this is not a good trade. Maybe maybe it's a good trade, but it's just not playing out. You kind of have to cut it early, or not cut it, but close logically, right? And we want to close, 50% or 75% of our position in drawdown logically, meaning we have to close it off. Candle closures, current wicks break, so break of structure or break current wick or break previous wicks. In this example, it's a current wick, break. If we were to get activated here and this would continue down, the 15-minute would look something like this, right? And just imagine this, right? It would look something like this. And obviously, if it looks like this, there is just a mini liquidity grab to the upside right here, breaking these highs, and we're closing back into this and breaking its own low. So it makes sense to either close 100% or 50% of the position, right? I would just close 50% in my opinion. But yeah. And I also have to do the math here, right? This is a 1-to-1 here, basically a 1-to-1. Let's just round up for this video's sake, right? 1-to-1. And let's say that you have your hard stops down there and soft stops here, right? Our goal is obviously not to lose, not to lose a 1 R right here, right? It is to lose less than that. So lose, 0.7 Rs, right? And then obviously our reward is 1 R, right? So this is original a 1-to-1, because if we lose 1 R, win 1 R, that's 1-to-1. But if we then, however, lose 0.7 and win 1, that is a 1.25 Rs, right? So that's a way better risk reward, but it's also done logically, right? And obviously there will be times where, you get entered, you push down, soft stops get hit, meaning you'll, manage your position, close 50% of that position, and then price is going to run up here, right? And then you have 50% of your position here, but you already closed 50% in drawdown, right? So that means, let's say that this is a minus 100 pip stop loss, then you close 50%, that's minus 50 points, but you also have 100 pip take profit, but you only have 0.5 of your position. So it becomes a break-even trade, basically, right? That's going to happen, but it also makes logical sense to manage this. And as I said, it's also subjective. Okay, it is really subjective. There's not a fixed way to manage risk in drawdown. I just like to do it off candle closures or breaks of current wicks in this example, or breaks of previous wicks. If there was some kind of previous wick here, there's probably one on the 5 minute, yeah, like these lows or something. But it is subjective. It's going to take time to learn, and obviously a 1-to-1 with a 80% win rate is super profitable. It really is. But just to add on top of the strategy, it is better to lose 0.7 hours than 1 hours, right? Because that becomes a 1.25 hour strategy with about an 80% win rate, right? Just to round numbers down. So it is better to manage your risk. It is more advanced, I know, and it's also subjective. That's why I can't really give a proper way. It's not fixed, right? It's not like I can draw it out in the playbook, for example. I can't do that. It's gonna take too much time. There's too many sub factors. It is really subjective, okay? But it's also very crucial. You have to understand how to manage your risk in drawdown to minimize your loss and to cut the loss early or manage it early to lose less than you anticipated, right? And I mean, yeah, so use hard stops down here and use soft stops logically. There's not going to be soft stops on every single position. It's just, there just isn't, because this is it's not unusual, but this is a position where it breaks previous within a 15-minute candle, push up, right? So yes, there's a 15-minute low down here, which ideally shouldn't be, tapped, because that would, mean I'll close 50% or 75% of the position. But if you go to the 30-minute, and let's say the 30-minute in this case was the 5-minute, for example, right? I mean, where is, soft stops going to be at? In the middle of the wick? No, that doesn't make sense, right? You have to use it on, current candles wicks, break previous candles wicks, or candle closures, right? So it's not going to, you can't really have soft stops on all positions you take, but on some of them, like this, in this example, it made logical sense to have soft stops here and, what's it called, hard stops here. Because let's say that this was 50% of the position. Let's say the stop loss was 180 pips and this is 70 pips. Let's just say it was 90 pips, so 50%. I would close 50% in this position. And then that leaves us with, if we close 50% at a negative 0.5 hour, that means we just close 0.25 hours, right? And then if these were to get stopped as well, we lose 0.5 hours, right? Equals a 0.75 hours, right? And then our reward is still a 1-to-1. That means if we were to win the trade, it would be a 1 hour, right? Meaning 1.25 or trade, right? That's kind of how I go. But it's also very crucial, because I'm going to take trades and you are probably going to take trades that doesn't, have a 1-to-1. In this case, it's a 1-to-1 because take profit was at equal highs, my bad. So it is a 1-to-1. But if we were to, put the stuff down here, basically a 1-to-1. But there's going to be trades where I take, a zero, like a negative RR trade. So I win, I essentially lose 1 hour if I don't manage the risk, and I only win 0.75 hours, right? But that's why it's so important, because we don't want to lose 1 hour. No, we want to lose, 0.75 hours, or even less if you can, logically, right? And that way it becomes not a negative RR, but it becomes a 1-to-1. 80% win rate, you get the idea, super profitable, right? But also it is advanced, it is subjective how to manage risk in drawdown. So I can't really give a fixed way to do it, but just remember, if it breaks structure to the downside, if it, candle closures, if you can really, what am I doing here? If you can identify that you were the liquidity, because there's going to be, positions where you try and take advantage of the liquidity grab, for example, right here, right? But you also end up being the liquidity grab, right? And let's say that this were to break right here. You can see that now, okay, we break, we broke these highs. This is a liquidity grab, but this is also a liquidity grab. So it's like, I would close 75 or, 100% maybe even if this were to close like this, if this 15-minute were to close like this, instead of, closing bullish, right? Let's just do it like this, right? If it were to do this after activating us here, yes, this does not make sense to be in the position still, because, you know, we broke structure to the downside, we broke, you know, current candle wick, we closed bearish, also, you know, breaking these highs activators and activating us in, right? There's going to be positions where your, you know, entry is the liquidity wrap, okay? Even though we still want to take advantage of the liquidity wrap. That's just how price is. It's going to liquidate to the downside, but also sometimes liquidate to the upside and then just move sideways or do some random stuff. That's just price action. Can't predict it. We can take it off probabilities and we can play the probabilities route, which is, you know, obviously what we want to do. But yeah, that's just how it's going to be sometimes, right? But anyways, beautiful trade. That's how I, you know, manage my risk in drawdown. And as I said, it's not going to happen on every single position, but when it does, remember to do it. And it's also tough. Another thing here, it's also tough to close a position in drawdown. I know, because you don't want to, as a human, you don't want to, you know, be wrong, basically. You don't want to make a mistake, and that's completely normal. But you'll have to think of it like this. You have to shift your mindset into thinking, it is better for my long-term growth to close 50% or 75% of, you know, my position if it were to break these lows, because I'm going to lose less than I'm anticipating, and then we'll just move on, come back tomorrow and look for the, you know, pre-planned trade, and then look for that pre-planned analysis, and then we take advantage of it, right? You're not going to win every single day. Yes, this has a high win rate, but you're not going to win every single day. You're going to have losing days. You're going to have losing weeks, and maybe even a losing streak, you know, 2 to 3 to 4 trades, right? It's all a game of probabilities. And, you know, let's say that, you know, what's the chance of losing? 20%, right? What's the chance of losing one position? 20%. What's the chance of losing 2 positions in a row? 10%. What's the chance of losing what's it called? 3%, no, 3 losses in a row, about 5%. I think that's how the math goes. I'm not really sure, but I'm like 95% sure. But, you know, it's all a game of percentages. It's all a game of probabilities. So you will have losing days, you will have losing weeks. That's okay, but you have to manage them. Manage them in drawdown. Be okay with taking losses, okay? But just learn from the losses, and remember, a loss doesn't mean it's a bad trade. If you followed your plan, didn't overtrade, didn't revenge trade, didn't over risk, it's a good trade. Just journal it. Maybe there's some small key points here and there you could have done differently. Journal it, adapt to it, and improve. Okay, that's what trading is all about. We learn, we make mistakes, we learn from them, adapt and improve and move on, right? So yeah, this is basically how to you know, manage your trade and drawdown. I hope you guys like that. It's a bit advanced video, I know, but yeah, I hope you found it helpful. And it's going to take time. It is advanced. It is subjective as well. But it's remember, it's important to manage your risk in drawdown. So yeah, see you in the next video, boys. All right, what's good, everyone? So how to manage your risk in profits, right? So now I don't close partials, okay? As of right now, I haven't really done it for around 2 years or something. But I don't close partials in profits, simply because if I were to close partials here, yes, in this example it ran. But if I'm closing partials, you have to think of it, like really go in depth with it. If I'm closing partials, I'm closing because I feel like, or I know, or based off, you know, experience, I know that price will most likely reject. Because if I close a position, it is logically, it is, you know, ideally where price will most likely reject, right? Because that's just how it is, right? But if I'm closing partials, that means that there's some kind of, you know, thinking in my head that price will most likely reject this area, and that way I don't do it. I'd rather just close, you know, go break even, and then, you know, hit break even, or lose a trade or win a trade. I don't close partials in profits. I close partials in drawdown, as you just went over that video before on how to do that logically. But I don't close partials in profits. Okay, I just close 100% or, you know, go break even, which is the next video, how to go break even. But as I said, how to basically how to manage your risk in profits, right? So you can trail. So sometimes it makes logical sense to trail your stop loss below current candle wicks, in this case in a bullish, you know, buy. Some cases it doesn't, okay? It's also subjective, and, you know, basically when to manage risk in drawdown, subjective. When to manage risk and profit, it also subjective on your risk tolerance, your way of thinking, and your experience, and what you're used to seeing on the charts, right? And when to go break even is also subjective. I've got traders in my community that doesn't even go break even. They just, you know, buy right there, let's say this is their entry because we got the same entry, right? They have their hard stops down there, and then they just have their take profit, and they just let it run because this is a draw on liquidity. Price will most likely hunt these equal highs up here, right? So they just let it run. Yes, they're gonna have a lower win rate, but they're also gonna have times where it will run, you know what I mean, right? But yeah, how to manage it in a profit, basically how to trade a stop loss. So you can do it off candle closures and wicks, right? So you can do it off. I'll go over another example of a trade I took yesterday of me recording this video, but you can basically do it off candle closures. So I'll go over how to go break even in the next video, but how to trail these stops. Let's say this 5 candle closed bullish right here, which it did, right? Next one pushes up, breaks previous 5-minute highs. Right here, I would just go break even. I wouldn't even touch it before we came up to these levels. So let's actually do that. If it were to break these highs right here, I would most likely go break even. And, there's a video on that for the next video right after this. But let's just say price was up here, right? Price is here. Now, this closed bearish, right? But I would most likely, manage my risk right here. I would move my stop loss in profits to this low, because if this low were to get broken, we would most likely, first of all, it's market structure. If it goes up, goes down, and then goes up right here, as you can see, broke previous highs and then breaks these lows. It's a break of structure, right? We'll most likely continue down to break even. And then we can even do something like this or even do this, right? So that's why I would close it. No, I wouldn't close it. I would trail it to this low, because if it breaks that, it breaks structure. If it breaks structure, it will most likely continue even further down, right? As you can see here, this is exactly what happened. We pushed up here, high, then we pushed down for a bottom wick right here, right? And then we pushed up, broke previous highs, and then we push another down, here, right? And then we broke these highs, and then we flew, right? So I would trail this stop. And it's also, as I said, when managing risk in drawdown, it's not going to happen on every single position. Some positions will just shoot directly up. Others will take a few minutes or an hour maybe, depending on how you trade, to really print market structure with highs, high lows, high highs, high lows, high highs, high lows, high highs, high lows, take profit hit, right? Which it did right here. High, this wick is the high. High, high lows, high highs, high lows, high highs, high lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher low, higher high, right? That's how the market printed in this, case right here, because the wicks is obviously the high and the wicks is also the low in this case, right? And this is the market structure if we go, really in depth. But yeah, so it never really broke structure here. You can see that this is a high, high, low, high, 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 low, high, 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 low, high, high. It never really broke these lows. So ideally, technically it shouldn't continue down here, because if it broke these, and that's why you can trail it in profits as well. Oops, let me actually go back. Can I go back here? Yeah, that's why you can trail it to, this low, then 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 this low, That's kind of how it is. That's kind of why it makes sense to trail in profits as well. So you could, when price comes up to here, I would probably go break even, or even I would maybe go break even here once it broke these previous 5-minute highs. And then, stops at break even right here. Let's just do that. And then I would most likely trail it. So after this 5 closed, I would trail it to this 5 low. After this 5 closed, I would still even have these lows, I think, or maybe trail it to this low. And then after this broke right here, this current 5-minute candle broke previous highs, I would trail it to this low, right? And then once this closed and when this broke through, either take profit hit or you can trail it to this low, right? Just let it run. That's also another way. You can have your take profit, but if price comes close to it, and let's say it closes right here, right? Look at this 5-minute closure. Take profit is here, but you technically can just, wait for this candle closure to break previous highs, break, and then trail it to this low, right? Do you see the risk to reward then, right? The risk to reward now becomes it basically becomes a trade like this. Stop is here and take profit is just wherever, because you're only losing this much profit, right? Original take profit was up here, but you're only losing this amount. You're losing about 20 points if it were to push down again, right? After tapping a break even, but you're gaining, a lot, right? So that way you can also do it. So at a take profit, you can, if it close to a take profit, you can, delete the take profit, but then manage it on the, current candles low in a bullish example and a current candles highs in a bearish example. So I would I don't know. It's subjective. Again, I don't know. In this case, I just closed it up here, but I could have, waited for this 5 to close. It's very close to the take profit. And then once this 5 candle broke previous highs, I would, I could have, trail these stops to here and then let it run. After this close, right, wait for a bottom wick. After this, broke previous highs, I could trail it to here. It is very subjective, and trailing in trending markets, trailing in profits in trending markets and in volatile markets, oh yeah, you can make a lot of money if you catch a really big trend like this, right? Let's just see for fun's sake, when we would have got stopped out, you would have traded to here, then traded to here, and then traded to here. You would have got stopped out right there, and your risk was only this, because you would have lost 20 pips in profits. Basically, you would have lost 20 pips. Let's say your take profit was 100 pips, but you only secured 80 because you traded to this low, right? But you still gained an extra, you gained an extra like 134, So it can be really powerful. But just keep in mind, if you have a take profit, it will most likely reject. But you still can try and do this, because you can milk the markets a good, portion by doing that. That's also something I'm going to look into. If price is close to my take profit, just delete the take profit, but then manage my risk and trail it in profits on the candles low or candles high, right? You can milk the markets that way pretty good, because you have no idea if price is going to do something like this. Push up and then just keep pushing like this, and then you'll milk it that way. But trail, stops, it's not going to happen on all positions, as I said, but trail stops and profits on current candles lows or current candles highs or previous candle lows and previous candle highs. Remember, market structure moves like this, right? High, high, low, high, 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 low, high, high, and you can trail to this, from this low to this low. So if this were to get broken, it's a break of structure. We just grab liquidity to the upside. We broke previous highs right there, grab liquidity, broke structure. It will most likely continue even further, right? So trailing needs to be done logically. You need to understand market structure, how it moves, and basically trail it that way. Because if it were to break structure and tap you out in a profit, it will most likely continue even further down, So yeah, that's basically how to trail profits in how to manage your risk in profits. Very useful video, useful, but it's also subjective. Remember that it's not going to happen on all positions. Some positions will just shoot directly up to take profit. Others will allow you to milk it a bit. But yeah, it's advanced. I know it's going to take time to learn and to do, and it's subjective. We are most likely not going to do it the exact same way, because trading is subjective. Trading is individual, but if you can do it and if it works for you, as I said, you don't need to do it. You don't need to manage your your risk in drawdown if it doesn't work for you. Okay, you don't need to trail your stop in profits if it doesn't work for you. If you're a set and forget trader, you just place your entry logically, stop loss logical, take profit logical, and just let it run, and that works perfect for you, then do that. You don't have to do this. Okay, if you can experiment with it. If it works, if you find out you make more money by doing so, then do it. If it doesn't work, if it's too complicated or it's too much cluster or whatever, don't do it. Okay, it is subjective. Everything in trading is individual and subjective. I don't want to force you into doing anything. This is just how I trail my stops in profits, how I manage my position in drawdown. But anyways, that's the what's it called, video for now. I'll see you guys in the next one. Peace. All right, what's good, everyone? So how to go break even and when to do it, basically, right? So in this case, same example as before. I will go break even based off market structure and internal liquidity grabs. Okay, internal liquidity grabs meaning liquidity levels, but smaller liquidity levels, right? You can see this is this is Asia highs right here, but this is not big enough, right? This is not my drawn liquidity. I don't think price, well, actually, I think price is going to go up here, but I think price is going to go further. I think price is going to go up here, right? So as I said, we have hard stops and soft stops, but also have hard take profits and soft take profits, if that makes sense. And at the soft take profits at equal previous highs up here or previous lows in a bearish example, this is my soft take profit, if you can kind of say. This is my break even area, because I'm gonna go break even, because you have to realize that price could do something like this, right? Price could push up here and then start flipping bearish again, and you look, that's just a liquidity grab on the now 15-minute, right? Because we broke these highs, right? So I don't want to be in this position if it starts rejecting heavily here, because that way will most likely continue down, So that way I'll go break even once it breaks previous highs internally. So this is actually like 70 pips in profits, or breaks previous lows in a bearish sample. But also market structure. Remember, if you go to the 5-minute again, right, I would also keep this in mind, this level in mind, but I would also, if we were to draw it out here, I would look at market structure. High, higher low, higher high, higher low, and I would go break even you know, maybe on this red line, or once this current candle breaks previous highs up here. Once it breaks these highs, I'll go break even, move my stops to break even, risk is off the table, and just let it run or start trailing, you know, as you guys saw in the last video, right? But you also have to keep in mind, you know, this is a high, higher low, higher high, higher low, higher high, higher low, higher high. If it were, you know, if we were to move this, and if it were to, you know, break these highs right here in profits at this internal liquidity grab, right? If it were to break these lows, let's say a break even is down here, it will most likely break structure and then continue down, and then, you know, do something like this maybe, or even do something like this. You're gonna have trades where you hit it will hit your take profit. No, it will hit your break even, my bad, and then price will run to your take profit, right? Which is annoying, I know, but you can't really do anything about it, right? If it did make sense to go break even, which it did in this case, I went break even once it broke these highs. That is a good trade, you know. Price will most likely not do it, but it can do something like this, right? Imagine this is a wick, pushes down, breaks us out, or what's it called, taps us out at break even, and then it's pushes, right? That's gonna happen. You know, it's avoidable basically, but you just have to stop, you know, over trading, stop, you know, jumping into a trade again, because that's the move. If it taps you out at break even, that's just how it is. It doesn't matter, okay? It really doesn't matter. Just come back tomorrow and do the exact same thing, you know. But a basic, you know, pretty basic, what's it called, when to go break even video, because you just have to do it on break of previous highs or new higher highs. As I said, it's a high, high, low, high, 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 low, boom. Break previous, no, this becomes a new high, high, and then you can go break even down here, because if this were to break, or you can trail stops to here or here, right here and then here. But if it were to break these, you know, the trade will most likely not be valid, because it's a break of structure here, and this now becomes a liquidity grab most likely, because it broke these highs, and broke these highs up here, you know. So you kind of have to, you know, you kind of have to see it. You have to realize that, okay, what happens if price were to push up here, but then start rejecting and start closing bearish again? What's going to happen? Well, this is on the 15-minute, and on the 30-minute, it is going to look like one candle. On the 30-minute, it's going to look like, you know, basically, wait, let me draw it out. It's going to look like this, right? 30 minutes going to close like this. That means we'll now have grabbed liquidity to the downside, but also to the upside. And this is a 50-50. This is a 50-50 range now. I don't know where price is going to go, because we grab liquidity to both sides, right? So I like to go break even, you know, basically off small liquidity levels, small equal highs, or small previous highs or previous lows or equal lows, and then still let it run to that original, you know, take profit, which I have in mind, which is these equal highs. This is a pretty easy draw on liquidity. When I say draw on liquidity, I mean like where price is most likely going to head towards, you know. This is equal highs. This was most likely, you know, previous daily, not previous daily, but previous days equal highs. I mean, price will most likely go there, especially if we grab liquidity to the downside, right? If we go out of replay bar here, took another trade. I took a trade yesterday. No, it was on NQ actually. Let me see. When was this trade taken? This trade was taken. Let's go to the NQ chart, because I took it on NQ chart. Yeah, look at this. Right here, it closed up here actually, but I did go break even on this level right here. No, I went break even because this happened, you know. This was exactly what I didn't want price to do, right? Now, in this case, it pushed up, you know, I took profits and I closed. But in this scenario, I still went break even here, and I went break even pretty aggressively, right? Because I knew that there was a chance that this was going to be the liquidity grab, and then price will continue down, you know. So good break even, good managed break even, and obviously not lucky, but it was good timing that I closed up here, you know. But basically, go break even when it breaks previous highs or breaks mini liquidity levels, mini equal highs or mini equal lows, and that way just let it run to your, you know, original take profit, which still makes sense, you know. That's kind of how I go break even. So I hope you guys liked that video and found it helpful. As I said, it's also subjective. We're going to have different break-even levels. We're going to have different take-profit levels. Everything is individual and subjective in trading. And it's also going to take time. And remember, if you get stop break-even and price runs to your original take-profit, don't re-enter. Don't take another position. Don't chase it. Don't overtrade. Don't over-leverage. No, just call it a day. Come back tomorrow. I do have break-even trades that I just get tapped out by a single pip, and then price moves in my original direction that I was anticipating. You know, that's going to happen. It's annoying. Yes, it's very annoying. But it also makes sense, or it made sense during the trade to go break even there, you know? So it's going to happen. And yeah, that's basically it. How to manage, how to go break even in a trade. I hope you liked it. I'll see you guys in the next video. What's good, everyone? So how to identify an A plus setup. So an A plus setup is basically the most ideal setup you can ever take, the most ideal entry you can ever take, right? If you see a setup, if you see an entry that looks kind of decent, or that, you think is going to go up, but you're still hesitant, there's probably a reason why you're hesitant. Either you don't have enough experience with taking that position, or you subconsciously know that it's not the best ideal position you can possibly take. It's not an A plus setup. It might be an A setup or B plus, but it's not an A plus, In trading, we want to take the best probability trades, highest probability trades, best possible trades ever, right? Because we want to maximize our win rate, maximize our risk to reward, right? And yeah, as I said, how to identify an A plus setup, really go in depth. Before you enter the trade, obviously pre-plan the trade ahead. Pre-plan what's an A plus setup is going to look like if it were to form, so you know exactly what to do. If I were to pre-plan, let's actually draw it out here. Let's do it like this. If I were to let's say that this is market structure right here, right? High, high, low, high, high, and then a consolidation right here, whatever, right? Equal highs, equal lows, and this is the continuation, consolidation, and then my ideal A plus setup is gonna break these lows, right? Break these lows and then reject, and then continuation post liquidity wrap, right? Now, I'm pre-planning that. I'm not looking for sells here. No, the overall trend is bullish. I'm not looking for something like this. But if this does happen, I don't care, okay? I literally don't care. I'm not going to enter, even though I know price will most likely, because it's breaking out of this range, it's most likely going to continue up. But it's not my setup. I can't feel FOMO about something that's not my setup, and it's not A plus. And if we were to, push down here, and then let's say right here, still creating equal lows, didn't liquidate, didn't push down here and then rejected. No, we pushed down here and then rejected right there, right? Still equal lows, still resting liquidity down here. This is an A plus setup or B plus. No, not A plus. This is an A or B plus setup. Okay, it's not ideally my setup. It's not the best possible trade. The best possible trade I could take is something like this, right? Entry either here, stop loss here, take profit up here, or entry, up here, take, stop loss up here and take profit all the way out there, right? But you have to really go in depth and be very picky about your trades, because every trade needs to be an A plus setup, needs to be the best possible trade you can ever take. And this is a perfect example of this. Look, if we go back here, I saw this live. Wait, why did I press on that? I saw this live and I didn't enter because obviously I entered here. But if we go down to the 3 minute or whatever, you can see that right here, I saw this and I saw, okay, well, these lows got broken right here, but this is not a big enough liquidity grab. It's not my setup. If price, I even typed it in the, wait, let me find this. Let me see here. Look, wait, can I, wait, let me see here. Look at this, right? I typed this in the chat. I would say NQ looks better than YM, but let's see what market open. I'm not taking this, and not a big enough a liquidity grab plus equal lows on the 5 minute. My anticipation was a push down to these lows, right? Push down to these lows and then a rejection, right? What did price do? Yes, it broke these lows, and technically also these lows before that, but broke these lows, but we still created equal lows down here. And I said, I don't care if price breaks here and pushes straight up. I don't care. It's not my setup. It's an A setup because we made a little liquid grab, but we didn't push down to what I was anticipating, what I was pre-planning, right? That's why pre-planning is so important. You have to do it on every single position. Pre-plan a trade before it even happens. Pre-plan your A plus setup so you know exactly what you're looking for. And if price does this, you don't settle for less. No, you don't take a dumb position. This is a B plus or an A setup. It's not an A plus, So I wrote, I'm not taking this, not a big enough liquidity grab. I don't think this will be the push, right? What happened, a few minutes after, we pushed straight down. So all the people that settle for less, all the people that, basically took this position because they were impatient and they wanted to catch this move, and they settled for less, right? They pretty much got clapped and took a loss right there, right? That's why I didn't wait for it. I waited for my levels, my red lines to get liquidated. And now if this were to break again right here, this would look even better and I would have taken it, right? And also wrote that, also text that if this were to do something like this now, yes, obviously I'm going to take that position because that's what I was looking for, right? That's why I wouldn't take the position. Good analysis on how to stay out and be patient, right? Because it wasn't an A plus setup. It didn't meet my A plus setup criteria. And as I said, again, A plus setup criteria are individual. It is subjective. A lot of things in trading are subjective. My A plus ideal criteria is not going to be the same as yours, most likely. Okay, maybe on some days it are, but on most days it probably isn't. You know, but basically stayed out here and then pushed even further to another red line I had. And what did price do? Started rejecting that. And then I was like, okay, textbook play, 15-minute. If it breaks, let's see, what did I? No, on break even. Okay, I wrote, wait, break of current. This is looking good. Break of current, 15-minute, right? And I was, having my, what's it called, entry up here and basically put, wrote it up, right? Hard stops here. As I said, there was some what's it called, soft stops within this 5-minute structure. This is a 50-minute time frame, but there were soft stops here. I would have closed 50%. Hard stops here, take profit up as this red line, right? But I mean, that's how to identify an A plus setup. Don't settle for less. Pre-plan the absolute perfect A plus setup in your idea and then wait for that. If it doesn't occur, if it doesn't meet your entry criteria, don't settle for less. Don't take a B setup, don't take a C setup, don't take an A setup, take A plus only. Okay, so important. That's basically how to identify an A plus setup. How you do it: pre-plan what the best possible trade could look for you before it even happens, so you know exactly what you're looking for, right? And that way you also won't get FOMO, because I didn't care if price moved without me in this position. I did not care. Okay, I said I'm not taking this, not a big enough liquidity gap. I could care less if price pushes 1,000 pips now. Didn't meet my entry criteria. I don't settle for less, So yeah, that's basically how to identify an A plus setup. Hope you guys liked it. I will see you guys in the next one. Yo, what's good, everyone? So if you don't wait for the liquidity, you will become the liquidity, okay? That's a good phrase I heard a couple of years ago, I think. But it stuck with me ever since, right? If you don't wait for the liquidity grab, you are gonna be the liquidity grab, okay? If price closes like this, just randomly closes above, let's say this significant level, right? Closes above, and you blindly enter here, stop loss here, take profit up here. You have not waited for the liquidity grab. No, you will become the liquidity grab once price breaks these lows and then makes a liquidity grab. Your stop loss got hit and you're basically the liquidity, But also remember that there's 3 phases in trading, as I said. You should know this by now: continuation, consolidation, liquidity. If this is the continuation right here, right? And then let's say that this is the, consolidation here, then another one, let's just write it here. Then price starts rejecting. We're still missing the 3rd phase here. We are missing the liquidity phase. There's no liquidity grabs yet. There's equal lows down here, yes. But where's the liquidity? We have not formed all 3 phases. And in order to get that continuation, we will most of the time need that liquidity. So if you enter here thinking that this is a good, high, high, low, and high, high, right? Then you will most likely become the liquidity, because you have to realize that, this is a continuation, this is the consolidation. We are missing the liquidity in order to get that continuation, right? So price will most likely push down and then flip bullish, and then that way. Just a quick video on, if you don't wait for the liquidity, you will become the liquidity yourself. So just keep in mind, and don't settle for less, don't jump in impatiently, and don't take dumb trades. Just wait for the liquidity grab to be a clear liquidity grab, stopping out everyone, and then you enter when everyone has got stopped out, right? And then your entry is logical, stop loss logical, take profit logical. So that's basically a quick video. And yeah, this was a beautiful ass trade, right? So the whole analysis, so my bad for being a bit slow. I'm on Mac right now. I'm not used to being on Mac, but let's actually delete this. So it was on NAS, right? The overall trend is heavily bearish. I mean, look at this right here. Let's actually delete all these arrows, right? The overall trend is heavily bearish, right? Then at, London Open, an hour after London Open, we get this huge move to the upside, and, filling this, kind of like filling this gap by like 50% or whatever, right? And we basically fill this gap. We also break previous highs up here, like all these buy-side liquidity. And I was like, okay, well, if we do this pre-session, we'll most likely continue down. But now, at market open, we still need some kind of liquidity grab to the upside before we can continue down, right? In order for price to go down, we need to go up first, right? Go up, grab liquidity, grab stop losses, grab orders, and then continue down. So we want to take advantage of that move post-liquidity grab, right? So pre-market open, let's actually go back in replay bar here. I think it's going to be easier for me to explain. Let's go back to pre-market open. Yep, the market open, right? Let's actually, first of all, draw these levels. So let's go to the 30-minute, right? I had my levels up here, something like this. Had a level up here, had a level down here, and had a level around here, right? And at pre-market open, I was anticipating that, as I said, if we continue up first, liquidate some kind of internal liquidity, then we can continue down post liquidity, right? So we need buy side to get liquidated. So I marked out this current
30-minute high. What time is this right now? Yeah, pre-market open. This is actually at market open right here, 9:30 a.m. Eastern. Next candle is 9:30 a.m. Eastern. I anticipate that we would continue up to these highs right here, right? Let's go to the 5-minute. I think there's equal highs. Yeah, exactly equal highs up there. And then if we did that, 30 minutes would push up, right? And then start flipping bearish. And we can probably continue down to sell side liquidity, down here or down here, right? Now, this trade was basically, I just waited for market open. I mean, it was pretty simple. Let's just play this fast forward a bit. Let's actually, where's the replay bar? So next 5-minute pushed straight up, right? Pushed up, grabbed this buy side liquidity. And I was like, okay, well, this is looking really good because I'm anticipating that the 30 at this time will break its own low and continue down. Right now, I just need entry criteria. The setup is there. The overall trend is bearish. We started moving sideways here, pre-market open, grabbing, or generating buy-side liquidity and their sell-side liquidity resting down here, right? And now we simply just need some entry criteria. So we need some 5-minute bearish closures or a 30-minute flip bearish, right? Now, next 5-minute, let's see here. Pushed up, bullish. I was like, okay, well, maybe this is just a kind of a double liquidity grab. So first liquidity grab up here, liquidating these highs, but all the people that entered here, right, anticipating that this was the liquidity grab, they got screwed with another liquidity grab, right? I was like, okay, well, maybe it could turn out bullish here, but I'm still anticipating sells because the overall trend is technically still bearish. I just need some kind of bearish closures here, right? Next 5-minute, fast forward, this was 9:45 now, right? Close bearish. And I was like, okay, well, this is looking good. I just need another 5 minutes to close below these levels, and then I can continue, take advantage of that move post liquidity grab. Anticipate that the 30 and 1 hour will, end up flipping bearish, which if you look, we obviously did, right? That was the analysis. Now, okay, wow, that's annoying. That's the annoying part about trading, replay bar. We can't really pause in time, but it's fine. It's fine. Next 5-minute closed, heavily bearish. And I was like, okay, well, this is my entry criteria right here. Took my sells right there. Stop loss. Hard stops up here, soft stops around on this 5-minute high. We can also even go on the 1 minute. And then look at this. Beautiful as 1 minute as well. We grab liquidity on the higher time frames up here, 30-minute, 15-minute, and 5-minute time frame, right? And inside this push right here, there's another liquidity grab on the 1 minute. So perfect. Entry was there. Okay, wait, now we just fast forward a bit. Okay, perfect. Entry was there on the 5 closure, anticipating that this 30 will break its own low down here and continue down, right? Which is obviously what happened. Now, entry was taking pretty simple trade. I mean, we just pushed down. Once we broke these lows, trailed my stop to this high, or like a high on the 2-minute or 1 minute, and then basically rode the wave down to these equal lows down here, which tapped perfectly, and we started reversing. I mean, it doesn't get any more simple than that. All right, what's good, everyone? What is good? So today we actually took a beautiful trade on US 30. And if you guys just look at this, can you already see what the entry is, right? The entry was right here. Beautiful trade. And I mean, let's just go over here, right? Now, the entry was here. Stop loss was here. Below the liquidity grab, obviously. And take profit was actually, it was on the previous 15-minute wake up here, right? I mean, super straightforward trade. The overall, technically the overall trend is bearish, but I mean, look at this price action. We were printing pretty bullish, and we can even draw it out here. We were printing like highs, high lows, high highs, high lows, high highs, consolidating, right? So continuation, consolidation, right? And then we get a breakout, we get that liquidity, and then, the continuation post liquidity, right? The liquidity web wasn't down here. This would also be very clean. If it was like this, then that would be even cleaner, but it wasn't like that, okay? It broke out of the bullish breakout right here. So if we draw the levels, right, there's a level here, there is a level down here, there is a level up here at this level, and there is a level up there, right? And obviously, we broke out of this level with this closure above, then the next closure above, 15-minute, 30-minute closed above, NYC, this candle right here, pushed straight down, liquidating not only the previous 15, but also the prior 15 low right there, and breaking previous 30-minute lows, right? Textbook play. I mean, very textbook play, just a breakout of a significant level, a breakout of this significant level, breakout of this significant level, closure above, right? Next one pushes down, breaks its previous low, stop loss below, entry current candle. It wasn't actually the current candle flip, it was the break of the current high. So if you go to the 5-minute here, it was also an impulse entry on the 5 minutes, so it was break of current 30-minute high, right? But it was also on the break of the previous impulse entry on the 5-minute, right? So it was this entry on the 5-minute, but on the 30-minute it looked like this, right? Because obviously, wicks are on the higher time frames are just candle closures and market structure the lower time frame, right?
So entry was right here, right? Break of previous 5, aka break of current 30-minute high, right? Stop loss, hard stops were below the liquidity grab, and my take profit was up at these levels, right? It actually, this previous 15-minute high could also have take profit up here. And that's basically the trade. But I mean, I could have never imagined price would fly up here. Like, I mean, I would have never predicted that, right? So, I mean, no FOMO, closed out at my level, which made sense at the time. And, you know, that's the trade. I don't have any FOMO. I don't care if price pushes up 1,000 pips now. It doesn't matter, right? We took the trade, made money, stuck to our rules, stuck to our plan. We executed and gained some pips and made some money, right? That's the beauty of it. And after that, I just called it a day. It was like a 2-minute trade. I was done by 9:45, and that was my day, right? And pretty straightforward. Now, we can also do the math here. Let's actually do this, right? Now, this may look like a negative RR. I mean, it also is on paper, but it really isn't, okay? You gotta understand why as well, right? So, this risk was 97 pips here. It was actually like, yeah, like 97. Yeah, so risk was, let's see, 97, right? 97 pips, right? And my gain was 82 pips, right? So I gained plus 82, right? But obviously, these hard stops right here is hard stops, right? When we broke the previous 5-minute high right here, I had my soft stops down here. So my entry is here. My take profit is up here at this red line. My hard stops are down here below the liquidity gap, but my soft stops is down here, right? So my soft stops are below the current 5-minute low, right? So if price were to activate us, right, push up and then activate us and broke that low, I would close 50 to 75% of that position, right? So if this is a 1 hour trade, we risk 1 hour. We actually don't lose 1 hour, because if price broke these lows, which is actually a 48 pip move, right, I would have closed 50%, right? And that obviously leads us to a negative 0.75 hour trade. So if we do it in percentages, let's actually do this again, right? I was not risking 1%. No, I was actually risking, 0, right? 0.7%, right, on that position. And what did I gain? I gained, my take profit was up here. So I gained, 0. How much did I gain? 8.5, right? 8.5%, right? So it doesn't become a negative or trade because I know how to manage my risk, right? And you should know that by now as well. It actually becomes a positive risk reward, right? So a we can do the math here. 0.75 times, no, 85. Is that how you do the math? Or it's opposite, right? So this times this, right? No, wait, am I stupid here? Wait, let me think here. Is it the other way around? Wait, is it like this? Yeah, like this. 1.13 R, right? So it becomes a 1.13 R trade, right? 1.13 R, right? And then that obviously equals with a 80% win rate, right? That's super, super profitable. And 80% is round down, typically 82 to 83%, right? That's just how to go over it by, it's okay. It is okay to have negative RR on paper, right? As long as you know how to logically get in, how to logically place your stop loss, and how to logically, place your take profit, where to get out, right? Because it made sense to get out here. And I had no idea if price was going to push straight up or reject the level. I honestly didn't have, I have no idea, because it is a significant level right here. It is above a previous 5 and 15 high. And I mean, that's just it, right? I had no idea if price was going to, push straight up or reject, right? So that's why I took profits. So it made sense for me to take profits. Made sense for me to enter right here on the break of the previous 5-minute high, post liquidity gap, post 15-minute liquidity gap, and 5-minute and 30-minute breaking previous lows, right? The overall trend is also bullish. You could also draw the CCL right here, so continuation, right? Then we get that consolidation, we get that liquidity grab, and post liquidity grab, we get that continuation, right? You should be familiar with this by now, right? I mean, super, super easy, simple trade, and pretty straightforward. I mean, beautiful trade, beautiful price action. This couldn't have been any more clean. You could also, if you want to, you can also experiment with having pretty tight stops, and in this case, just having stops right there. That's up to you, right? That is up to you. You can experiment with that, but I like to keep it as soft stops here and hard stops down here. Then manage risk if it breaks these lows and close 50 to 75%, losing less than we were anticipating, right? But that's basically trade for today. Beautiful trade, and yeah, I mean, pretty textbook. I mean, break above, liquidity wrap, breaking previous lows, right? Break above, liquidity wrap, breaking previous lows, and yeah, that's it. So I hope you like the quick trade recap for today, and I'll catch y'all soon, and we'll speak soon. So let's go over this trade real quick here. Let's delete this level. Now, let's actually go to the daily time frame, right? The annoying thing about TradingView is that it can't really pause its time, so this ended up pushing up, but just forget that, right? But anyways, this is a overall bearish trend. You can look here. We can even go back a few bars here. Overall bearish trend, pretty easy to see. If we go to daily, it's also bearish. If we forget the daily candle right here, if we go back a bit, one bar right here, it's bearish, right? The overall trend is bearish. Hence, I'm taking sells because it's more likely to go down than up if you're in a pro trend versus counter trend. If you go to the 1 hour as well, bearish trend. It's pretty easy, right? Now, if we go to the 30-minute, let's actually skip ahead here. This is the annoying thing about TradingView replay bar, but it's fine. It's fine. If we go here, right? This is let's go to the 30-minute right here. This is a overall bearish trend. This right here is the continuation, as you can see. Continuation bearish. Now, this is the consolidation right here, where price is moving sideways. Whenever price is moving sideways, it's generating buy side and sell side liquidity, aka stop losses, aka money. Now, at market open, this was taken at 9:45, so yeah, 15 minutes after market open. And at market open, is price just gonna shoot down? Most likely not. It's most likely gonna push up, liquidate this, manipulate that, and then push down, right? But I'll get into that here in a second here. So if you go to the 30-minute, now, do you see how I use the daily, 4 hour, and 1 hour for direction? Bearish, right? Now let's delete all these levels as well. Let's just delete everything. Now I go to the 30-minute to identify my significant levels. There's obviously a level right here. Look at all these rejection. There's a level up here. Look at all these rejections up here. There's a level down here. Look, this rejection. And there's a level. Let's go to the left here. Let's zoom out. There's a level down here, right? There's also, you can kind of say, equal lows down here, which is what I'm targeting, right? So that's my potential take profit if price were to push up here and then flip bearish, right? Now, this is, let's see here. This is market open actually, 9:30. Like this is the 9 a.m. to 9:30 candle, right? So market opens right now. And I'm anticipating that price wants to do something like this. If I were to draw it out as well, push up and liquidate this buy side, because there is buy side liquidity resting above these stop losses, or these wicks up here, right? Because liquidity equals stop losses equals money. Because most traders has most likely gotten into sell positions right there after this rejection, because it's an overall bearish trend, right? But their stops are up here. There's equal highs up here. There's two forms of liquidity, above or below equal highs or lows, or above or below previous highs and previous lows. They're pretty much anticipating this move right here. Well, what happens? We're on the 5-minute time frame right now. Market opens, shoot directly up. That's like 100 pips already within these first 5 minutes. Then the next 5-minute candle pushes all the way up here, liquidates everyone. So all the early sellers got liquidated, and now we want to step in, right? When everyone has gotten out, we want to enter. That's basically how you want to see it, because 99% of traders are unprofitable. So just do, or just don't do what 99% of traders are doing, but do what the top 1% is doing. They are waiting for the 99% of traders to get stopped out and then entering, right? So now the entry is taking right here on the 5-minute time frame. You could also zoom down to the 1 hour. You can see a clear break of structure, push up, bearish candle, break of structure down here. Clear textbook play, right? Stops up here, right? And then we target sell side liquidity down here at these equal lows, which are marked out to the left of us, right? It is a textbook play, but do you see how the 15 just closed right here? No, the 15 is still open, my bad. The 5 just closed. The 30 is still open. The 1 hour is still open, and I'm anticipating we will get a bearish flip to continue down, right? The 15 is still open at this point. Remember that, right? So what happens? Well, price just instantly shoots down, take profit hit, and that's basically, if we go to the 5-minute, this is the annoying thing about TradingView. I mean, it can't pause time. It's just, yeah, but whatever. You kind of get the idea. We just shoot straight down, right? But this is what I mean about top-down analysis and how to use the daily, 4 hour, 1 hour for direction and bias, and also the weekly, and then the 30-minute, 50-minute, 5-minute to identify the buy side and sell side liquidity, and then take advantage of that liquidity grab post or I mean, take advantage of that continuation post liquidity wrap, and that's basically what we did.
So that is the full course right there. And as I said in the beginning, I could be charging thousands of dollars for this information right here. And I'm giving away completely for free to you. No charge, no nothing, right? So please leave a like, comment, and subscribe. It means the world to me. And if you watched it this far, you watched the entire thing, right? I know that you are dedicated and motivated to trading. And if you want to change your life with trading, achieve financial, time, and location freedom, you can apply for my one-on-one mentorship where everything is tailored to you. It's not signals. It is not a group coaching or like a community or whatever. It's one-on-one coaching, right? Everything is tailored to your situation, your problems, your everything, right? So if you want access to that, if you want to become profitable, guaranteed. Yes, it's guaranteed. You can check. I've changed hundreds of people's, hundreds of unprofitable traders' lives with trading now that have gotten profitable. You can check the case studies if you want to. It's also in the description. And yeah, go watch the video. It's like 5 minutes or whatever. And hope you guys like that. Leave a like, comment, and subscribe. Rewatch it if you need to. Rewatch some of the chapters. And otherwise, thank you for watching, boys. I hope you liked it, and I will see you in the next video. Take care.